October 28th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. U.S. stock futures, they are in the green. This is after the S&P 500 and the Dow Jones snapped a 6-week winning streak. Investors now preparing for the busiest week of this earnings season. 42% of the S&P 500 companies, they're reporting. We've also got within that 5 of the Magnificent 7 stocks releasing results in the coming days. And the earnings will really shape the overall view of the current reporting cycle and season and could propel the tech sector to retake market leadership after an underperforming last quarter.
Plus, the other test for investors this week, the latest read on the economy. October payrolls and PCE data will largely cement the Fed's rate decision at its November meeting. Core PCE, that's the Fed's preferred inflation gauge, is going to provide some insight into the central bank's fight against inflation as the U.S. economy continues to show signs of resiliency.
And ahead of its earnings results this Thursday, Apple will host a week of events where the company will release the first features of its long-awaited Apple Intelligence technology. The company is also expected to reveal an overhaul of its Mac line using its in-house M4 processor. But the big focus ahead of its results will be the head of the new and the health of the new iPhone cycle. Shares are up nearly 36% over the past 12 months. Investors are gearing up for a big week ahead of earnings, economic data, ahead of the presidential election next week, of course. So all of this in mind, just take a quick gander, if we can toss that full screen back up on the screen here for our viewers to see, just the companies and the sheer force that you're going to see reporting over the course of this earnings season, and really going to be zeroing, at least for me, on some of those tech companies. You got Apple, Microsoft, Alphabet really leading the pack in terms of the market cap of the companies that are going to be reporting. And then, of course, you've got Amazon within there as well, and Meta Platforms. So we're going to get a good read on both the consumer as well as where there's still legs to the AI trade, even given some of these companies that already talked about it being one of their weaker quarters of investment to begin the year, and then ramping up and accelerating some of that CapEx as well.
Yeah, it's quite the week for you to come back from vacation.
I know, I'm excited. I'm pumped, Shauna.
We're not giving you any time. We're throwing you right in. But let's talk about what exactly is at stake this week, because we have so many of those big important names reporting like you were just saying. And here we are. We're not too far from those record highs. So a lot could be riding on these corporate results and exactly what that tells us about the momentum, not only through the end of the year, but also as we get guidance for 2025. We've been speaking with a number of analyst strategists, even economists, over the last several weeks, and many of them just talking about those guidance figures when we try to gauge just the health of the economy, health of corporate balance sheets, and what exactly that is going to look like pushing ahead to the new year. And as we take that all into account, you've got earnings, and then you've got those very important econ data numbers as well, right? And there could be a lot of noise in these numbers. There have been a number of analyst strategist notes out over the last several weeks talking about how much noise could be in these prints when you've got the hurricane, when you've got numerous strikes happening, exactly what that means, and not only for these numbers, and really just how reliable these numbers could be. And then you have Bloomberg Intelligence saying that, hey, we could actually get a negative print on this October payrolls report. So how the Fed would look at something like that, too, is something that's a big question.
100%. I mean, big week for, and I kind of summarized this at least within my notes, jobs and mega caps. That's going to be the focus of this week, especially with the labor data that you were mentioning coming out over the course of this week. Of course, really kicking off with the prior and backwards looking JOLTS, of course, and that's going to be beginning. And then we get into the ADP private payrolls, and then, of course, into the monthlies. But one of the other things here, too, just to round out this conversation and perhaps set up our next one as well, the earnings growth hasn't been up to snuff, or at least up to expectations to this point in the earnings season. Looking at some FactSet data here over the course of Q3 2024, or for the quarter of Q3 2024, the blended earnings growth rate has been 3.6%. That was anticipated to come in at about 4.4%. So we're still well below that as of right now, and we'll see what these companies reporting this week have to tell us.
And so much of that is riding on the Mag 7 numbers, too. When you take a look at the earnings growth that we're expected to see there and compare that to the rest of the market, 18.1% growth, I believe, that we are expected to see this quarter here from the Mag 7 companies. Let's dig into those earnings results that are out later this week as investors gear up for the busiest week of this earnings season. Joining us now, we want to bring in Dan Flax. He's Neuberger Berman's senior research analyst. Dan, it's great to have you. And let's zero in on the tech sector because I know that is what you are closely watching. When you take a look at these Mag 7 members that are set to report this week, how much is riding on these results?
Good morning. Good to see you. I think it's going to be important in terms of getting an update on some of the cyclical factors. There's clearly patches of weakness in the consumer. I think the enterprise is slower. But if we step back and think what's happening, you have this build out of the digital platform, the cloud, artificial intelligence. These secular trends remain healthy in my view. So I think what we'll see, for example, with Microsoft, their Azure business, I think you'll see good growth there. I think with Amazon Web Services, you'll also see healthy growth there. And I'll also highlight the Google Cloud business, which we think is an underappreciated opportunity for them. And so I think that will remain healthy. We'll see how Apple, what they say in terms of the very, very early days with the new cycle. Apple Intelligence, of course, is rolling out, and we'll see a lot more there in the weeks and months ahead. So we see select opportunities, being, of course, mindful of some of the cyclical dynamics.
You know, the earnings bellwether coming into this season had been NVIDIA for several quarters at this juncture. But is it possible we see one of the companies this week, from your purview, actually take over that bellwether status and really set the tone, especially going into and amidst the fourth quarter as we get a little bit more of the outlook about the consumer and even the setup for 2025?
I think NVIDIA is going to remain important in terms of its partnership with a lot of the cloud vendors like Microsoft, like Amazon, like Google. They're an important partner for Meta, of course, as well. I do think if we look at Amazon later this week, we'll get a read into the health of the consumer where there is some softness. I think the cloud business, which is a critical driver of the company and the stock, I think remains healthy. I also think they have an underappreciated opportunity in advertising. But to dig in a little bit on Amazon, what they're trying to do, even in this more difficult period, and we'll see what they say about Q4, is really drive more value in Prime, as an example. So more one-day and same-day delivery, more video offerings. And so the key in this period is that you need a company to be able to invest, set itself up for growth, while at the same time, of course, navigate some of the challenges that all the companies are facing, given weakness in parts of the economy, both here and overseas.
Dan, what about the risk of hyperscalers pulling back on AI spending? How real is that risk, and when do you think we'll likely see it?
The hyperscalers are investing aggressively because they have tremendous revenue opportunities. You see it in their backlog. The spend is inherently lumpy, and so we're in a period of very, very strong growth now, and so some of the growth rates, I suspect, will moderate over the next year, although the absolute dollars being invested, I think, will continue to grow. These companies are trying to take and have been able to take a multi-year outlook in terms of investing to drive growth in key areas like the cloud for new workloads, such as artificial intelligence, while at the same time knowing they have to navigate all the cross currents in a given quarter, manage their costs, try to deal with unforeseen events, which of course occur very regularly.
Dan, are you seeing any signs of AI exhaustion?
I don't think it's exhaustion. When we speak to customers in the enterprise, a lot of them are very excited and interested, and they are investing in artificial intelligence. And what they're trying to do is to isolate specific workloads where they can get value. So, for example, software coding or contact center or automating more of their processes. And so it's a step-by-step for each organization. The cloud companies are able to scale it and see a return on these investments in a reasonable time frame. So they, in contrast to the enterprise, should continue to invest aggressively, in my view.
You know, anybody who's firing up the NASDAQ composite or even the NASDAQ 100 this morning and thinking about the number of components within that composite that are going to be reporting over the course of this week, they're going to be looking at how close these companies are in aggregates to all-time highs. Have valuations run too far, and what are you going to need to hear from companies to say and suggest that they're able to grow into those valuations and scale into them at a healthy rate?
What we look for is really companies that have distinct intellectual property that they're able to execute on their product cycles and really do that again and again as technology markets transition. So they need to generate durable revenue growth, and they need to translate that into strong free cash flow, which they can in turn invest back into their business or return some to shareholders. When I think about valuation and I think about the free cash flow generation of some of the companies, Microsoft is an example, Apple is another example, I think valuations are reasonable. What we're focused on is really how the second half of this decade is going to shape up. And so clearly 2025 is very important, but we're trying to think through and position for 2026 and beyond to really capture some of the significant growth opportunities that we see, while of course being mindful of some of the near-term cyclical challenges that all companies are facing.
Dan Flax, who is the Neuberger Berman Senior Research Analyst. Dan, thanks so much for taking the time here ahead of the opening bell this morning. Appreciate it.
Thank you.
Certainly. Let's stick with the Mag 7. It's a big week for Apple. The tech giant is expected to announce a bevy of updates this week, including the release of the long-awaited Apple Intelligence. Big upgrades to the Mac are also on the agenda, and here with what's to come, we've got Yahoo Finance tech reporter Dan Halley. Our tech DH, Dan, what should we be watching for here?
Yeah, Brad, there's a number of things coming here. Obviously, Apple Intelligence, probably the biggest announcement that we're expecting. Apple hasn't said exactly when it's going to launch, but the reports have been pointing to this week at some point via a software update. But then there's also this kind of week of announcements that we're expecting from the Mac line, and that includes potentially a new MacBook Pro, a new iMac, and a new Mac Mini. That's according to Bloomberg's Mark Gurman. And they would all come equipped with Apple's M4 chip. And so these are all getting updated with the latest silicon that Apple has to offer. They had launched their iPad Pro with the M4 chip earlier this year. It provided more power, especially for the neural engine. And that's probably the biggest kind of piece of this announcement is on the neural engine side. Because they're doing this big push into AI, you'll still be able to use Apple Intelligence on Macs running the M1 and newer, but it looks like what they're trying to do is really roll out the M4 along with the Macs and say, look, if you want to get the best experience for Apple Intelligence, this is where it's at. So when it comes to the Mac, the iPad, and the iPhone line, they all essentially get similar features with Apple Intelligence. Those include things like notification summaries on the iPhone, which I've been using as part of a beta and are hugely helpful, especially when you get tons of Slacks, texts, regular news updates. My fantasy football was coming in summarized. It just kind of helps clean up the notification mess that you likely have on your own phone. And then they have updates to photos. There's a thing called natural language search, which allows you to do things like, I could search for my cat lying on the couch and it'll pull up pictures of that, or my wife and I in France in a certain kind of dress or something, my wife wearing the dress, not me, and it'll pull that up as well. And then they also have updates to allow you to do things like make certain edits to photos as well. And then some priority notifications for mail. Those are all helpful. I think really the big thing that people are going to get the most use out of, though, are those summaries. We're expecting Apple to roll out a improved, or not improved, but a greater kind of tranche of updates to Apple Intelligence with 18.2. That's the next version of iOS that'll be coming. Same for iPad, and then 15.2 for the Mac. And those will include things like ChatGPT integration and so on. And so you can expect that to be the one that I think gets people most excited. Right now, I think this is just kind of a jumping off point, and people will really get by the most use out of the summaries.
All right, Dan Halley, thanks so much for breaking that down for us. We're going to talk a little bit more about that coming up next hour. Coming up next, though, on Morning Brief, we count you down to the opening bell on Wall Street as stock futures trade in the green ahead of the open. Plus, we sit down with the CEO of Southwest to talk about the airline's recent agreement with activist investor Elliott. And Philips cutting its annual sales growth target due to weak demand out of China. We will speak with the company's CEO next on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. All right, first up here, let's go to the skies. Boeing launching a nearly $19 billion share sale to help strengthen its finances. The company offering $90 million in common stock and then $5 billion in depository shares here. Now, the company's finances are taking a hit from the ongoing machinist strike, now in its 7th week, and that has halted some of the aircraft production, costing the company about $1 billion per month. Workers rejected the latest proposal last week, which included 35% wage increases. And it seems like one of the sticking points as of right now within this negotiation is machinists really being upset that the pension was stripped out of some of the updates, and that really being one of the areas where they're continuing to try and take Boeing to task right now, too.
Yeah, and I think the big question here for analysts, for so many people out on the street, is exactly what type of financial position this puts the company in right now. We know that they have been bleeding cash. Right now, they are expected this quarter to burn through about $4 billion. As you look ahead to the next quarter and next year, what exactly that looks like with these ongoing strikes, how long that is going to affect Boeing, that is a real question. And to put this in perspective, this is the largest cash raise that we have seen in years. When it was reports that it was only going to be $15 billion, we were looking at the largest since 2020. Now this number exceeding it here with $19 billion. So it is the largest equity offering that we have seen in quite some time. And we know Boeing is very much in the position where it needs this capital infusion to bridge that gap that they could see here now, which could last maybe longer than many of the strategists, many analysts had expected it to, at least initially.
Well, it comes back to their credit rating, too, because if you do see this strike continue to move forward, Boeing continuing to see a hit on its financial performance, then the credit ratings associations would then have reason or have cause to downgrade their credit rating, thus making it harder for Boeing to get capital in another capacity. And so this one of those preemptive measures as well, massive as it is.
All right, let's take a look at ON Semiconductor. They reported better than expected third quarter results. The semiconductor components maker, chip supplier here, posting revenue of $1.76 billion, with free cash flow increasing 41% sequentially. Was initially higher on the back of that news, but again, as the earnings call is underway right now, we're looking at a bit of a reversal here in shares, now off nearly 5%. If you're not familiar with this company, they heavily rely on the automotive industry, and lots of talk going into this, and really what they have seen over the last several quarters is that many of these companies ordered way too many components coming out of the pandemic. They've been working through this inventory glut. That has been something that has been weighing on this company now for quite some time. So they did beat here, but again, it was a drop on a year-over-year basis. So the fact that we did see lower earnings in the third quarter as revenue did fall despite the beat here, it doesn't look like that's enough for shareholders.
Yeah, only thing I'll add to that is really the focus on more energy, more power. And this company talking about that as well. And I think that's going to be key, especially as you hear more executives who are even engaging with or touching the semiconductor space or have reliance on the data center businesses. Powering these data centers is going to be amazingly critical for how many chips are going to be going into the future of the data center if we get towards a 1 million chip data center, for instance. And here's where the company is talking about it. The CEO of OneSemi saying, as power demand continues to rise across their key markets, the need for greater efficiency becomes paramount. They're investing heavily right now to win across the entire power spectrum to ensure that they're best positioned here. That's similar to what we've heard from Oracle and Larry Ellison. That's similar to what we've heard from NVIDIA as well, and how companies are looking at everything from, okay, where can we just get more energy, more power? Do we need to get nuclear reactor sites? And that's increasingly becoming talked about and should be on every investor's bingo card as of right now.
Yeah. Or you're missing out on opportunities.
Absolutely. All right, another company that we're talking about here this morning, Philips shares plunging. The medical device company cut its full year sales target after weak demand from China weighing on its third quarter. To discuss, we've got Roy Jacobs, who is the Philips CEO. Plus, we've got Yahoo Finance's very own Anjali Khemlani. Great to have you here with us. So first, Roy, you got to just take us into this quarter and really the challenges that you're seeing right now. Is there any abatement in sight for some of those overseas and Asia Pacific challenges that you were citing?
Yeah, so when we look at the third quarter results, we saw two parts. One, we saw strong margin delivery. So we stepped up 160 basis points in margin, despite that we had flat sales growth. And that flat sales growth indeed was driven out of further deterioration in China, where actually we saw two underlying trends unfolding. One was the consumer market, where further drop in consumer sentiment led to further sell-out drop and sell-in drop. so actually weak consumer market, but also we had the hospital market where actually we expected the stabilization of demand, and that also further deteriorated. So you see that a slower macroeconomic environment in China continues to have an impact, and that we had to reflect into our full year sales outlook, despite the fact that we see actually growth in other parts of the world really picking up. And in particular, in North America, we see a very strong order flow. We see a very, very strong sales momentum as the underlying demand in hospitals is growing for innovations because they don't have the staff to deal with the current demand, radiology, pathology, but also interventional suites. So we see a mixed picture in the world from growth perspective. So we focus very much on what we can control, which is driving margin expansion, as well as delivering on the cash for the full year.
Roy, Anjali here, really good to see you again. Talk to me about why China is weighing so heavily, considering exactly what you talked about. We know that from the insurance earnings, we've seen that increase in utilization, and that's translating, of course, into business for you. So how do you compare the two buckets when you think about the increase in the US and how long you think that's going to be maintained, because we know it's pent up pandemic demand versus the amount of business that you do in China and why it's so important?
Yeah, so if you look to China, to start there, you see that on average sales for Philips, it's 10%. But we have two segments that are having disproportionate more impact. It's the consumer segment, where we saw a significant drop-off, where actually it's more significant than the 10%, and also the D&T segment, so the diagnosis and the treatment segment, which actually has a bigger share of total Philips sales in China. Now, that has been really affected. Now, we think that actually China will come back. The question is not if, but it's when. And currently, the visibility is just very low, and that we had to reflect back in our forecast also moving forward to the full year. At the same time, we think that the improvement in the North American market is a structural improvement. If I compare 3 consecutive years, we had 22, where we had significant still COVID impact. We had a lot of hospitals with negative numbers. 23, we saw many coming into the positive. 24, we see the financial bench strength really strong, and we see that they have wait lists in patients. So the number of procedures are still growing. The number of patients needing an image is growing, and unfortunately, the wait lists are long. So actually, we still see significant strengthening of that demand in North America. And on top of that, also on the consumer side, actually, we have seen North America gaining momentum. So North America is strong, China is weak, but also we see some other pockets of growth in the world. I was 3 weeks ago in Indonesia, 280 million people in very strong need also of healthcare. They have a lot of shortage of doctors, so innovation and technology needs to come in to help them to become more effective and efficient. So we were discussing that with the biggest private hospital chain in Indonesia. We also see in Latin America, actually, that momentum is coming back. So you see different growth speeds in the world, and you need to be agile to address and tap into that. And you just saw that the China impact currently is significant, and therefore you cannot react to it in a quarter. But if you look to the longer perspective, we see growth momentum outside of China picking up, and at a certain point, China will come back.
Got it. And talk to me about AI really quickly, because I know I just came back from a conference where it was the talk of the town. We know that it's picking up in healthcare use. It has been a big part of imaging for a while. Where are you seeing the greatest demand for innovative AI in medical devices?
So I think you can say in general, if I talk to the staff shortage, that where you have nurses short, technicians short, and doctors short, we need to look at how we can support them in their daily work. It starts with routines. When they are doing reporting, how can we automate their reporting? When they're doing a diagnosis, how can we actually speed up the diagnosis? We have a smart speed algorithm that actually is increasing the speed of an image by 3 times. I just came out of Japan. We see 25% penetration of that algorithm on all the MRs that are in Japan from Philips. That's a significant uptake in a very short amount of time because it just doubles the productivity of that MR in the market. We see another need for pathology. You see that actually there are not a lot of pathologists in the world. So actually we have a digital pathology solution that really scans and then actually helps with the interpretation and the diagnosis. So indeed, as you say, there are many practical kind of applications here and now that we can apply in areas of shortage or where healthcare is in crisis.
Just quickly, do you see that application of artificial intelligence or additional technology replacing or just being in annexation or in tangent to existing roles within the healthcare space?
No, it's really supporting, because the problem in healthcare is that we have significant shortages of people. So actually, we cannot get enough people to step into the practice. We have seen people stepping out after COVID. We've seen burnout rates, and we see the queues in healthcare kind of becoming bigger. So actually, we are supporting the doctors with better tools to do diagnosis faster, to do minimally invasive therapies, or actually to monitor patients in a more predictive manner. We're helping the technicians to actually go through their technical workflow in a faster manner. And we're helping the nurses so that actually we can expand, for example, the ratio of how many patients they can watch after in an ICU from 1 to 7 by the use of a tele-ICU application. So there are distinct needs areas where actually this is enhancing the staff currently, not replacing them.
Roy Jacobs, who is the Philips CEO. Great to have you here with us, Roy, alongside our own Anjali Kamlani. Thank you so much.
Thank you so much. Have a good day.
Absolutely. You too. Guys, coming up, opening bell. That's coming up next. You're watching Morning Brief. There you're taking a live look at the opening bell. At the NASDAQ, you've got the American Bankers Association doing a remote bell ceremony there. And then you've also got Covenant at the NYSE ringing the opening bell there. Ticker symbol CVLG. Okay, let's get to it here. Taking a look at the Dow Jones Industrial Average as we begin today's trading activity. Fractionally higher to begin today's session. We're seeing it up by about 0.5% right now. I gave you a look at the year to date here just so you can have a full look at what's going on. It's up by about 11% over the course of this year. Also, the NASDAQ Composite, that's still holding on to gains of about 24% over the course of this year, up 0.7%. So even despite snapping that longer winning streak that we had seen for some of the major averages here, of course, still holding on to some solid gains. Right now, we're up by about 22% year to date for the S&P 500 here today. Out the gates, we're up by about 0.5%. Let's take a brief look at some of that sector activity, as we always do. 11 S&P 500 sectors. We've got them loaded up for you here. Just one laggard, and that's energy. Down bad, 1.9% right now. All the other sectors, though, seem to be in positive territory and holding on to some gains to start today's trading activity, led right now by, oh yeah, you guessed it, communication services. That's up by about 1%. And then additionally, you've got consumer discretionary up by about 0.8%. So with that, let's get on over to Yahoo Finance's Jared Blickery for a deeper dive at what's moving here at the opening cross. Hey, Jared.
Well, thank you, Brad. Since you left it here, I thought I'd just start with energy and come back to it. That's down because of crude oil having its worst day in a couple years since 2022. Has to do with an Israeli airstrike that was not as bad as feared. But I do want to start with the broader markets here. And I'm going to go to the NASDAQ, where we are actually entering. This could be the 8th straight week of wins for the NASDAQ. Notable because we just said, well, the S&P 500, they snapped their 6-week run there. And Brian Dietrich ran the numbers, and he found that a year later, after the S&P 500 snaps a 6-week winning streak, that it goes on to be up about 19 of 22 times. That's the history there. So strength begets strength. Although there are a lot of worries about the election and whatnot, and we've seen sentiment dropping, but nevertheless, you got to look at price action, price pays, and we are seeing the S&P 500 and the NASDAQ maintaining crucial levels and sometimes even forging those record highs. The NASDAQ really close there. Here's the sector action once again. Wanted to go to Apple. Now, Apple and the chart of the overall NASDAQ composite look very similar. You have this kind of flag that's developed over the last few months and just waiting for a catalyst that makes it punch through to the upside or to the downside. We'll have to see which, but these things do tend to resolve themselves in favor of the longer term trend. And in this case, that would be up. And I do want to take a look at crude oil. You can see natural gas down a little bit more, 7%, but crude oil down 6% to the lowest levels we've seen since September. And that goes back, those levels probably hold for a year. As I said before, there is a strike by the Israelis on Iranian facilities, not as bad as feared. They avoided the nuclear facilities as well as some of their crude oil production refineries. So on the back of that, we have just dropped to these multi-year lows or thereabouts. And so with crude at a critical level, I got to think now the calculus is going to be what is OPEC Plus going to be doing. Perhaps they do meet over the coming week, and no expectations in their current strategy are expected, but things can change.
Certainly can. All right, Jared, thanks so much for breaking that down for us. Well, this week is certainly going to be a busy week for Wall Street. Third quarter PCE data and the October payrolls report this week will hit both ends of the Fed's dual mandate and will largely cement the central bank's rate decision ahead of its meeting next week. Joining us now, we want to bring in Stephen Dover. He's the chief market strategist at Franklin Templeton Institute. Stephen, it's great to have you. So how should investors be shaping their portfolio, or should they be making any changes ahead of what is going to be a very eventful week?
Eventful week, eventful 2 weeks, actually. I don't know that they should shape their portfolio around this. I think there's sort of a few things going on right now. Very positive news. Obviously, not having a real big strike in the Middle East was positive, except for oil prices. China's stimulus over the last couple of weeks is very positive for overall global growth. We have a couple economic announcements coming out this week that are likely to be positive, 25 basis point cut coming up, and then the elections hopefully will be settled within the next couple of weeks. I think just having those elections settled, whichever way it goes, would be positive. I think the market seems to be pricing in, or over the last week priced in, probably a Trump victory. If that doesn't happen, there's probably some unwinding around that.
And then additionally here, I mean, as we think about some of the economic data, how muddled is this economic data going to be, especially considering some of the natural disasters, of course, showing up within the jobs prints that we're going to be looking at. And then additionally, you think about more broadly how that's going to kind of overflow into the Fed's thinking, even at their next meeting.
Yeah, it's going to be muddled. We had 2 hurricanes. We have the strike at Boeing. So it'll definitely be muddled, and it'll be muddled by the politicians because literally they will interpret this just as we go in this week. So I think it'll be hard. I think that said, the futures markets are very strongly predicting a 25 basis point cut, and that's still likely. But I think we could have some volatility around the week as those numbers come in. To use your word, probably a little bit muddled.
Stephen, what do you make of earnings season so far? When you take a look at the big picture, maybe there's some cause for concern, but underneath the hood, you're looking at many sectors that are tracking ahead of expectations. What does that setup then look like heading into big tech this week?
We think as we're heading into this week that earnings could be solid. We're pretty positive on the market looking forward. There's a little backup in interest rates that we've seen, but despite that, the market keeps moving ahead. That doesn't mean the market won't consolidate at different times as it moves ahead. But if we're to look ahead, a longer period, end of year, 1 year, it looks pretty positive, both from an earnings perspective and just general growth. And as I mentioned, I think we look beyond the United States and see the possibility for growth globally, which is obviously also very positive for the market.
Within that, for tech this week, I mean, how much of the burden is tech bearing to really kind of lift up the broader earnings growth here, which is lagging below expectations, at least according to FactSet. Right now, we're sitting at about, 3.6% earnings growth reported for the season. That's versus their expectation of about 4.4%. And information technology is leading right now, but it really places even more emphasis on just a few names, several names, to really uphold the rest of the market here.
Yeah, good point. So we're very dependent on a few names. 5 of the 7 are reporting over the next couple of weeks. Those will be very important reports, and they'll be market indicators. That said, we do think the market is likely to broaden out. We think, especially likely, depending on the earnings results, the market could broaden significantly, and it could be opportunity, especially for smaller cap stocks. So point is, yes, very dependent on those big companies, but we're seeing broader earnings and a broader market is what we're seeing over the course of the next year.
Stephen Dover of the Franklin Templeton Institute. Thanks so much for taking the time here with us this morning.
Thank you very much.
Certainly. Coming up, everyone, Southwest CEO Bob Jordan joins us live. He'll weigh in on the airline settlement with activist investor Elliott Management and the impact of Boeing's ongoing strike. You're watching The Morning Brief.
Southwest Airlines and activist investor Elliott Management reaching a settlement to avoid a proxy fight. The deal adding 6 new directors to the airline's board and speeding up the retirement of executive chairman Gary Kelly. This coming after Southwest reported better than expected third quarter results. Joining us now to talk all about that and more, we want to bring in Southwest CEO Bob Jordan. Bob, it's great to have you back on Yahoo Finance. Thanks so much for making the time to join us.
Hey, thanks for having me this morning. I really appreciate it.
So, Bob, let's first get to the settlement with Elliott. Of course, we have been closely tracking this at Yahoo Finance, but what this settlement includes 6 new additions to your board. I'm curious, what is the biggest lesson that you learned throughout this process?
You know, I think I'm just really pleased that we have a chance here to now turn all of our attention to the transformational plan that we laid out about a month ago. It's all about execution. It's all about all eyes forward, and we've got a terrific plan. And you mentioned the new directors. It's actually 5 as part of the agreement with Elliott. Mm-hmm. And I've talked to all of them, had a chance to interview all of them, and they each bring something to the board. You've got 2 that have run airlines. You have one with FAA experience, one that's a CIO, as an example, one with retail hospitality experience. So that added a lot to the board. And at the same time, we were also already talking to Pierre Breber, who was the former CFO at Chevron, and he'll come on at the same time and add a lot to the board as well. So it all happens in just a few days here. We reconstitute a new board, and I'm very eager to work with all of them.
Yeah, so it was 5 put forward by Elliott and 1 put forward by Southwest, I believe.
That's right.
So
That's right.
Apologies for lumping that in together. But Bob, let's talk about what exactly these new board members, especially the 5 from Elliott, how you see that's changing the strategy, the conversation surrounding some of those turnaround plans that you've laid out for investors.
Well, I think number one is you just want good people with the right set of skills to come onto the board. And again, I've had a chance to talk to all of them. And number one, they all want to do good for Southwest Airlines, just like I do, just like our former and then the board members that carry over. We want to do good for Southwest, for our people, our customers, and our shareholders. So we are totally aligned there. And again, they bring a lot of different skills. We'll now have 4 former airline CEOs on the board, and they bring a mix of skills. You know, they folks that have run legacy airlines, folks that have run ULCC low-cost airlines, folks that have transformed airlines. So I think they'll bring a lot of good perspective, a lot of good discussion. You know, at the end of the day, you want the board to challenge you. You want the board to make Southwest Airlines an even better company. We have a great plan, and we are all looking forward to executing that plan, including our new board members.
You know, Bob, recently when we've heard about airline transformations, it's been with the mindset of extracting even more margins, extracting more profits from the business. Where do you believe that the customers might actually be kind of bearing the brunt of either additional costs, or where within the service that you're already providing, there may be some significant changes from the customer experience that then ultimately lead to shareholder value?
Well, we started with what our customers want. You have to start there. We surveyed tens of thousands of customers. It was a very scientific process, and we actually used a third-party consulting firm as well to validate the results. And it was really clear. Our customers want assigned seating, 80% and more want assigned seating, and our customers want premium. So we'll be adding premium extra leg room. And we have other things coming. We have a new Getaways by Southwest Vacations product. We're adding airline partnerships starting with Iceland Air in the first quarter, and so much more. But number one, we started with what our customers want. You must meet their needs. And at the same time, we have the opportunity to sell to our customers things that they want. That's the perfect match. So it's not fees for things like bags. It's revenues that come because our customers want to pay for these new services. So it's really a win-win. And again, it's now all about execution. We'll have the assigned seating and extra legroom for sale by the second half of next year, and then operating the first half of 2026. So I'm very excited about that. I'm very excited about meeting our customers' needs.
Bob, you certainly have a reputation for problem solving. You overhauled the airline's frequent flyer program in the past. You oversaw the acquisition of AirTrain. You also led the new flight reservation system back in 2017. When you talk about this new strategy, the new turnaround efforts that are ahead for Southwest, how does what you're dealing with today, how does that stack up against some of the issues or some of the problems that you've solved at Southwest in the past?
You know, Southwest has been through many transformations throughout our history. If you think back, years ago, we were almost all short haul. We had plastic boarding passes, open seating. And over the years, we evolved. We changed our boarding because our customers wanted that. We changed our frequent flyer program because our customers wanted that. And now we're adapting again to what our customers want. But I think this is probably the most significant transformation in our history because we're changing very fundamental things. Again, like the way we board, the way we seat folks, the extra leg room. But it's very exciting. Our people are very excited. And again, I keep going back to the number one thing you need to do is understand your customer, 5 and 10 years from now and meet their needs. A good example, earlier this year, we added Google Flight Search, the meta search engine, and Kayak, and we added Skyscanner last week. And again, it's just because that is where many of our customers are shopping today, and you've got to meet their needs. But no, this is a big transformation, so it's all about execution, and we'll get it done.
Bob, when I spoke with Delta CEO Ed Bastian earlier in this earnings period, he talked about some of the issues at Boeing and when they're expecting to actually take delivery of their MAX 10s, which have yet to be certified. You have a more outsized exposure here, and some of the issues at Boeing as they're playing out, at what point do you see that continuing to impact the finances, but also impacting things like route schedules, things like what type of capacity you could have, and the maintenance costs as well of the existing fleet?
Well, Boeing has been a great partner for the whole 53 years of Southwest Airlines. But we need Boeing to be strong. We need Boeing to be better. It's been years since we had deliveries that came in for a year the way that we expected. And 2024 was significantly interrupted by the Boeing delivery delays. We started the year expecting more than 80 aircraft, and we'll get 20 this year. And with the strike lingering on, it looks like 2025 could be affected as well. We planned appropriately. We planned for a strike duration in the 4 to 5 to 6 week range. But the longer this goes, the more it could impact 2025. So there is uncertainty. I've been in close contact with Boeing, including over the weekend. And again, I'm looking forward to them getting back on track and becoming reliable in terms of the deliveries, because the heart of an airline is the flight schedule, and the flight schedule depends on getting your aircraft on time.
Bob, have you had talks with Airbus?
We are constantly reviewing the market. It's a duty that we have to our shareholders, to our board, and we look at all aspects of the market, including Airbus periodically, and we'll do that again. That's not something that we are actively doing today. I'm very focused on getting the aircraft that we have in the order book. And a big piece of what we revealed at Investor Day also was a fleet monetization strategy, because there's a lot of value in the Southwest Airlines fleet. So in addition to the aircraft that we need to expand and replace retirements, we have the opportunity to monetize aircraft that maybe we don't need given the new lower growth rates, but we've got to take the aircraft to be able to do that.
Bob, while we have you here, some of the holiday bookings data that we're looking at right now, how would that data lead you to describe the consumer right now?
Well, first, I'm really pleased with the third quarter results, because we did make a lot of tweaks to the revenues, especially in the revenue management system, and those actions have really begun to take hold, which is why you saw a very solid RASM or unit revenue guide, and then we actually beat that. And we've got a good, solid sequential improvement in our guide again in the fourth quarter. So that's a terrific spot to be. But to your question, the bookings look really good right now. They look good overall for the fourth quarter and ahead, and they look very strong for the holiday period. So at this point, the consumer looks like they're very much holding up, and there's a lot of demand for air travel.
Bob, before we let you go, we would be remiss without asking you about Frontier and Spirit reviving their merger talks. What does that potentially mean for Southwest?
I can't comment on, obviously, any other carrier, what they may or may not do. I think overall, Spirit and Frontier aside, the backdrop is very constructive right now. You're seeing capacity come down. Our capacity has come down quite a bit. We'll grow in the 1% to 2% range here over the next 2 to 3 years. There are a lot of constraints. Obviously, the Boeing deliveries, you've got the geared turbofan with Pratt. So the backdrop in the industry looks very constructive to me.
Bob Jordan, Southwest CEO. Thanks so much for taking the time here with us, Bob.
Hey,
really
thank you for
appreciate it.
having me. We truly appreciate it.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each or less. Let's go. First up, we got Mickey D's, the Golden Arches, Arcos Dorados, McDonald's. Their quarter pounder, without its slivered onions, is going to be returning to restaurants impacted by the E. coli outbreak. The company's saying it feels confident any contaminated product has been removed from the supply chain. Shares rejoicing, up by about 2.3%. The CDC had actually taken note of it and put out some key points. It seemed like there were 3 new states that had been added to the number of states, bringing the total to 13 here. Michigan, New Mexico, Wisconsin, or Washington were the newer ones there. So McDonald's saying it's all clear.
We'll see what demand looks like for those quarter pounders. All right, let's take a look at Eli Lilly. It got approval to sell its weight loss drugs in Hong Kong. That's according to a report from Bloomberg. Now, this coming after the company got approval to sell its drugs in China back in July. So the reason why this is so significant is its rival Novo Nordisk. It's already selling its diabetes drug in Hong Kong and in mainland China, but it's the weight loss version has not yet been made available. So this is why this is so significant to Eli Lilly. Just in terms of the details beyond that, very light in terms of what this ultimately could mean for the company's bottom line. But obviously, this is a huge step just in terms of exposure and what that could ultimately mean for Eli Lilly then down the line.
Absolutely. And sales of Apple's iPhone 16 are being blocked in Indonesia. The country saying Apple failed to fulfill the requirements that smartphones and tablets sold in Indonesia have at least 40% of its parts manufactured locally. Of course, this is part of the domestic investment requirements that Indonesia has for some of the products or all of the products being marketed and sold within that region. And so we'll see what type of ultimate impact this has on Apple. But Apple has invested about $95 million in Indonesia, but falls short of an investment target that they had set forth as well.
Could be a challenge here, at least in the short term. All right, well, that does it for Morning Brief, but keep it right here. Catalyst coming up next on Yahoo Finance. Welcome to Catalyst. I'm Shauna Smith. We're 30 minutes into the U.S. trading day, so let's get to the three catalysts that we're watching this hour. First up, we'll be breaking down the two big data points that the Fed's watching this week that will likely shape the next rate decision. Plus, we'll bring you full earnings coverage as 42% of the S&P 500 companies report this week. And we count you down to the election and take a look at the trades in focus with just over 1 week until voters head to the polls. We have two critical data prints out this week, September PCE inflation and the October jobs report. The last piece of data that we get before the Fed's next meeting on November 6th and November 7th. Joining us now, we want to bring in our very own Jennifer Schomburger. Jen.
Hey there, good morning, Shauna. That's right. Two key pieces of economic data will seal what the Federal Reserve will do at its November policy meeting. On deck, a fresh reading on the Fed's preferred inflation gauge and the October jobs report. The Fed's preferred inflation gauge, that so-called personal consumption expenditures index on a core basis, which excludes those volatile food and energy prices, is supposed to show inflation cooled 0.1% to 2.6% in September from 2.7% in August. That would follow a warmer than expected reading on the Consumer Price Index for September. Meanwhile, the jobs report may not offer officials a clear assessment because it could be buffeted by two major hurricanes that temporarily caused people in the regions affected to be out of work. Economists expect 110,000 jobs will be added for the month of October, which would mark a drop from the stronger than expected 254,000 payrolls added in the month of September. The unemployment rate is expected to hold steady at 4.1%. Now, if these reports come in fairly as expected, that will pave the way for the Fed to cut by 25 basis points at the next meeting on November 7th. The wild card is going to be the jobs report. If that comes in stronger than expected, some analysts say that could cause the Fed to pause. If it comes in weaker than expected, don't necessarily expect the Fed to cut by a jumbo 50 basis point rate cut because of the hurricane distortions.
Yeah, Jen, that was my question there. Just in terms of how much emphasis do you think is going to be placed on this jobs report versus past jobs report, or maybe what we historically see from the Fed, just given that noise that you've been outlining?
Yeah, absolutely, Shauna. I think that Fed officials are going to probably look through this report because they know coming in that there have been two major hurricanes that have disrupted large swaths of the southern part of our country. We'll also probably see a little bit of the Boeing strike impacting the report as well. This, of course, coming after a stronger than expected September jobs report. They're looking for consistency. The data's been very choppy. They're looking for trends. So I don't think that this one report is going to cause them to think that, oh, the job market is certainly weakening here. We need to come in stronger and front load. I think they're going to need to see more subsequent jobs reports to confirm if that is indeed the trend.
All right, Jennifer Schomburger, as always, thanks so much for breaking that down for us. Let's turn now to the bond market. After its worst sell-off in 6 months, yields are resuming their climb higher this week ahead of a slew of catalysts that could chart their course for the rest of the year. Joining me now, we want to bring in Dennis Gartman. He's the former editor and publisher of the Gartman Letter. Dennis, there's so many places to go, but let's start with what Jen was just talking about, the latest econ data that we're getting out this week and what ultimately that would mean for the Fed. We were going through some of the predictions or some of the expectations ahead of Friday, and actually Bloomberg Intelligence is predicting a negative payroll print on Friday. I'm curious, if we do see that, how do you think the Fed will likely respond?
That would be shocking. I can't imagine that's going to happen. It's possible, but I put the odds of that happening less than 1 in 100. It is possible, but I think it's highly improbable. I think that the number will be closer to 100,000. But you have to remember that if you get the non-farm payrolls within 70,000 on any one month, the revisions have averaged about 75,000 for the past several years. I think it'll be about 100,000 plus or minus 75,000. But do I think there's going to be a negative number? Not on your life. That's just not going to happen. We do have two hurricanes. Clearly, those are going to have distorting circumstances prevailing in the numbers. But I can't imagine it's going to be negative. That's a true outlier. No question about that.
So Dennis, then let's stick with maybe more so the fact that this data could be distorted because of the hurricanes, because of other factors that are going into this print. How much then does that complicate the Fed's job and as they try to decipher what is exactly going on within the economy?
Clearly, it complicates things, but not that dramatically. It's they tend to take a longer-term perspective. They look at moving averages rather than the monthly data itself. And they look for trends to see what is developing. So I think that this is the bigger problem shall be the fact that they don't want to look political, and the fact that we're having this right after the election is disconcerting and a bit confusing. But they will I think they'll go through with a 25 basis point cut. Earlier this year, the consensus was there'd be 6 cuts in the overnight Fed funds rate. I laughed at that and said there'd likely be 1, maybe 2. I was wrong. There's going to be 3. But that's a long distance from 5 or 6. Over the course of the next 2 years, we'll probably see the overnight Fed funds rate get down to 2.5% to 3%, and the yield curve will go back to a positive slope. the long end rates at the long end will go higher because of inflationary concerns. Rates at the short end will go lower because of the Fed becoming more accommodative. So that's my story, and I'm sticking with it.
Dennis, let's talk about some of those inflationary concerns and exactly how this pertains to the election. There was a great piece out in the Journal today going through Harris's policy versus Trump's policy and what ultimately that could mean for inflation. And obviously there has been so many economists coming out saying that actually under Trump, we could see inflation reignite just a bit. I'm curious your thoughts on that. And ultimately, does that put some of the progress that the Fed has made at risk?
My biggest fear going into the election is that we'll have a Democratic House, Democratic Senate, and a Democratic president. That's not going to happen. My next biggest fear is that we'll have a Republican House, a Republican Senate, and a Republican president. The problem shall be that no matter who takes over, if we have an overwhelming landslide in one direction or another, they will both be inflationary. The best of all worlds will be probably a Republican president, a Republican Senate, and a Democratic House. So we'll get gridlock. Nothing much will happen. They can't hurt me when they can't do anything, and that's probably the best of all worlds.
Why is it better for a Republican in the White House versus Dem?
I just have always tended to be somewhat right-wing in my orientation. Republicans tend to be, not have always been, but tend to be somewhat more fiscally responsible. But Mr. Trump has been fiscally irresponsible, and Ms. Harris will be at least as fiscally irresponsible as Mr. Trump shall be. So on balance, Republicans have tended to be fiscally responsible, but this, I think, is a different type of Republican, no question.
You know, but Dennis, when you take a look at the ballooning deficit, that's been something like you're talking about here that has been garnering some headlines, yet investors don't seem to be too concerned, at least at this juncture. How big of a risk is that down the line?
For 40 years, I've been in the business for 50 years, and for 40 years, 45 years of my 50 years, I have not been too concerned about the deficit rising. And it has been somewhat problematic, but now for the first time in my lifetime, I'm actually becoming very concerned. The fact that the deficit is now, $3.5 trillion a year. We're going to 36 or $37 trillion in the overall budget deficit, or the debt that we have. That becomes problematic, and I think it is, for the first time in my lifetime, disconcerting, dismaying, and the fact that I have a new granddaughter. I'm worried about the economy and the country as we have fiscally going forward. For the younger generation, it's my first time to be very concerned.
Well, congratulations on your granddaughter, Dennis. That's very, very exciting. Let's turn to earnings season before I let you go. So far, we're taking a look at corporate America. It looks like earnings overall holding off, although we have seen some of these expectations come in below those lowered forecasts here from Wall Street. What is the number one thing that you're watching for here over the next couple of weeks?
I think that stock prices, to me, have become egregiously overextended, and they have anticipated good earnings, better earnings, great earnings, consistently strong earnings, and we've seen more beats than we've seen failures. So I'm a little concerned about stock prices to the level that they have been, but I've been concerned about stock prices for the past 4 or 5 months. The only trade that I have on for my own account is I'm long of gold and short of stocks in equal dollar amounts, and it's been working to the course of a couple percentage points in my favor. It's against me today, and I'm a little bit concerned about that, but I'm more concerned about inflation. I'm more concerned about the deficit rising, and I'm very concerned about the fact that a large number of the public is involved in equities that has not been involved in the past. And I think the thing that scared me the most was the fact that the CNN Fear and Greed Index, which is one of my favorite indices, reached one of the most overextended periods or numbers in the course of the past several years last week, and we're going to be even more extended now. So I'm very dismayed, very concerned, and shocked by the fact that stock prices have been as high as they have been. So Dennis, I've been wrong for the past 6 months, and when you're wrong, admit it.
You're wrong until you're right. Dennis, I guess when you take a look at where levels are today, we're not too far from those record highs that we hit last week. How big of a pullback? It sounds like we could be set up for a pretty dramatic pullback at this point. What do you think that could potentially look like?
10 or 15%. That's the standard bear market. That would be, to me, a reasonable correction that we should get developing. The fact that we've had an inverted yield curve for as long as we have, it's actually gone back to being a slight positive slope at the very short end of the curve for right now. And the fact that we've had an inverted yield curve for as long as we have, that to me indicates recessionary circumstances. But again, that's been something I've watched for 50 years, and it's proven itself to be less than satisfactory in the course of the past 6 months.
Dennis Gartman, always great to have you. Thanks so much for making the time to join us again here at Yahoo.
Thanks for having me on.
Talk to you soon. All right, coming up next, we've got Apple Intelligence reportedly set to debut today. What to expect from that launch next on Catalysts. Set to be a very busy week for Apple with a new Mac lineup and earnings on the agenda. The tech giant also reportedly releasing the first iteration of its widely anticipated Apple Intelligence. The update, which has already been previewed by early adopters, will give the general public a hands-on look at how Apple is putting AI to work. Joining us now, what to expect, we want to bring in Philip Shoemaker. He's the executive director of Identity.com and founding director of the Apple App Store. Philip, it's great to have you here on Yahoo Finance. Let's talk about how much is riding on this launch. Is there a risk that Apple's going to fail to live up to the hype?
Yeah, I think that's a big risk, right? We saw this many, many years ago with Apple Maps, where Apple dives into a direction that is unfamiliar to them, and sometimes they stub their toe. In this case, I'm hoping that's not going to happen, because Apple Intelligence has a lot of hype around it, and it's really exciting to have this type of technology directly in your hands. And so I think that there's a good chance they're going to do well. But look, the fact that they're shipping iOS just 18.1, that's missing a lot of the critical features for Apple Intelligence, might be a flub on their part.
So I guess, Phil, what is the better way then you think to go about this? Just hold the release, or maybe hold the launch of the iPhone? I guess as they try to maybe correct some of that course going forward, what's the best approach then from Apple?
Well, what they should have done is they should not have announced it so early. But But moving forward now, yeah, they should really just work to make sure that it's going to live up to our expectations, because we expected 18.1 and our Apple Intelligence in general to really drive iPhone sales, which it didn't really seem to do, right? We're going to see the earnings in a few days, but the concern is that they overpromised and underdelivered, which is something that Apple rarely does. But in this case, they just need to really ensure that when they release this, that it is rock solid and lives up to the hype that they announced back in September.
How big of a boost do you think this is going to be for demand?
I think if it does exactly what they say, I think we're focusing more around 18.2, which is going to be next year. And when that launches, I think people are going to see why you need a new device, why you need to have the new chipset, and to access this functionality, and it's going to skyrocket at that point.
So is 18.2, is that really the game changer, you think, then for Apple?
Yeah, I think the one we see today that's going to roll out this week is not going to deliver much other than proofreading and rewriting technology, rewriting your posts, et cetera. But 18.2 is the clincher. That's going to be the one that is a game changer.
Philip, do you think it's going to be enough for some of those naysayers out there, some of those critics who have been saying that Apple is just way far behind when it comes to AI adoption and where they should be within this space? Or will there still be some questions surrounding that, just given the delay and the fact that we won't see 18.2 now for some time?
Yeah, I think you hit the nail on the head. There's going to be a lot of naysayers out there, and it's going to be really difficult to live up to the hype. Now, the hype is what they announced back in September. That's changed since then, right? There's new functionality, new features rolling out, things like ChatGPT and Anthropic's Claude, that Apple's going to need to continue to integrate and leverage in order for their system to take off. So I think it's a big risk. It's going to be hard to live up to the hype, and there will continue to be naysayers until Apple releases the whole shebang.
Philip, what do you think is the number one thing that investors need to keep in mind for Apple's earnings report later this week? Obviously, more of an emphasis on the App Store, some of the services aspect of Apple. That's been the case now for quite some time. Are we going to get anything this quarter that you think is enough to really propel the stock to higher highs?
Look, it's all services. It's been that way for so many years. This is the first release that I saw in 8 years that Apple did some functionality that you need the new hardware other than just the camera. And so for me, I expected this to really take off, but the fact that they didn't get Apple Intelligence out at time of shipping really affected. So no, I think we're stuck with streaming services for now.
All right, and there was another big headline that we were tracking here at Yahoo Finance today, and that's the fact that Apple is being blocked from selling the iPhone 16 models in Indonesia. Obviously, the significance of this, what this could do ultimately for demand. There's a Bloomberg estimate out there saying that it's estimated 354 million devices are in active use in Indonesia. How significant, how big of a challenge do you see this potentially being for Apple in the near term?
Yeah, and you know, it's these commitments to do natural resources, natural manufacturing, et cetera, in certain regions like Indonesia, and the fact that the new president came on just 8 days ago and enforced this against Apple is painful for sure. But look, I think it's something Apple can fix relatively quickly. They're not necessarily going to build a manufacturing plant there, but they can ultimately do something along the lines of investing more cash into the local economy, and that'll be able to take off sales. I think it's really just a hiccup for Apple, and they can get back and selling relatively quickly if Tim's willing to open the purse strings.
All right, Philip Shoemaker, thanks so much for taking the time to join us, Executive Director of Identity.com and Founding Director of the Apple App Store. Coming up, earnings, economic data, and an election. Investors have a busy week ahead. A closer look at what is next over the next several days. We got that coming up for you next on Catalysts. Investors are bracing for one of the year's busiest weeks on the docket. The October jobs report, along with a slew of other economic readings in a busy week of earnings, including 5 members of the Mag 7 reporting results and the final stretch of campaigning before Election Day next Tuesday. Joining us now to discuss what this means ultimately for investors and how they can best navigate a potentially volatile week or several weeks. We want to bring in Michael Gayed. He is the publisher of the Lead Lag Report. Michael, it's great to have you here on Yahoo Finance. So I think so many investors are sitting at home right now trying to figure out just what is the most important indicator release on the economic side, or whether it's earnings that they need to be paying closest attention to, or even the election. What would you say?
I mean, candidly, I don't know if any indicators matter at this point. It's purely about liquidity, as we know. Most things which are typically signals or signs of risk have not really been right this year. Meaning, you know, I always go back to this example that if you started the year and knew with perfect foresight that gold would be as strong as it is, that utilities would be as strong as they are as a defensive sector, you probably would not think the S&P 500 would be doing as well as it has so far. I think the more interesting thing, though, which has been an area which has whipsawed a lot of people, will be how small caps behave in the weeks ahead. I say that very purposely. For the last year and a half, I've been saying on X repeatedly at Lead Lag Report that small caps hold the key. Small caps are the part of the marketplace which are most sensitive to rates. Mm-hmm. This part of the marketplace which has the most number of zombie companies. I'm not saying that because of Halloween coming up. Mm-hmm. If small caps were to take a stand here, that would be an indication that this really is going to be another move higher for equities. If small caps get turned away here, I think it's trouble for large caps.
Michael, what is, I guess, going to be the catalyst then for small caps to make a stand? Because there's lots of questions about how much has already been priced in.
Well, I think you kind of answered your own question with that, right? How much of it is priced in? I mean, small caps haven't done anything really since 2021. Certainly after inflation, they're below their 2021 highs, broadly speaking. And I keep going back to small caps are the small business equivalent of the stock market. Now, it does look like the market is broadly expecting that Trump is going to win. It will be interesting to see how, if Trump wins, how small caps perform. You had a juncture in 2020 between the Biden election plus the reopening trade post-COVID, where small caps went absolutely vertical relative to large caps. You had one of the most stunning moves in relative performance we've seen in a long time. It would not shock me to see that happen again, a repeat of what happened in October, November for small caps of 2020 in this year, 2024. But again, if small caps don't move, I think it's going to be a problem. This has been the part of the marketplace which has held back, I think, a lot of the broader animal spirits.
So, Michael, let's talk about what ultimately big tech earnings could mean then for the market. Is it going to be a wait-and-see type of mode? What is it that you think investors should be prepping for?
Maybe. Again, earnings, I'm not so sure they matter when this is purely a story of AI and PE expansion, all right? If price is going up at a faster clip magnitude-wise than earnings, and I don't know if price is based on earnings as opposed to just hope. I'm sure it's going to provide somewhat of a catalyst for certain gaps in various large cap companies, but I would go back to the idea that this is about a narrative. This is not about fundamentals.
So, Michael, then looking ahead to election volatility, that's a big concern. You talk about the fact that we could have questions about the results of the election, what exactly that could mean then for how big of an influence that will have. Do you see a spike in volatility then on the horizon?
It's certainly possible. Again, first of all, seasonality-wise, we typically don't have that kind of a vol spike, but anything can happen, especially given how, I'd argue, off-cycle things have really been the last 2 years, especially when it comes to the way the bond market's obviously behaving here. So, yes, it is possible. Now, I think if you're going to have that vol spike, the question is, what do you do about it? Typically, the best ways to play defense are defensive sectors. Consumer staples have been a laggard. I think they could probably show some outperformance. Utilities have continued to outperform. Partially that's the AI trade. Partially I think that's also expectations for rates coming down, which again we haven't seen. And then gold. I don't think that gold momentum is over by a long shot. Gold is typically not only a signal and indicator, going back to our earlier conversation, but tends to be a beneficiary of risk. And I think gold's been sending a warning for some time here that something's off.
All right, Michael, thanks so much for taking the time to join us. We want to switch gears and focus on the auto sector. Ford earnings coming out after the market closes, and investors watching this report very closely as sluggish consumer demand and low EV adoption continues to weigh on the sector. To discuss what investors should be watching, we want to bring in David Underkoffler. He is Autolist Editor-in-Chief. David, it's good to have you. So yes, there has been some concern about sluggish demand in EVs or for EVs versus what maybe the initial forecasts were. But when you take a look at the earnings out from GM, you take a look at the earnings out last week from Tesla, they were actually very strong. Does that at all signal maybe what we could hear from Ford after the bell?
I would say probably not. If you actually if you dive into some of the details of both the Tesla earnings and the GM earnings, you can sort of see it's not necessarily EV product based or demand based. On the Tesla side, a lot of that was their energy components. And they also sold a number of regulatory credits. That's always sort of been kind of a fallback for them and a good source of income. On the GM side, they were able to, it was not as much tied to EVs, but they were able to cut costs, but their average transaction price of their vehicles was about the same. So they were able to have fatter margins there. So for Ford, I wouldn't expect EVs to sort of be the make or break case for how their earnings perform in Q3. And another thing that's notable about GM is they're actually going to, according to Mary Barra, by the end of this year, their EV division or EV vehicles will actually be profitable. That's what they're forecasting. That's actually a pretty big deal in the industry. Only Tesla is the other automaker that has achieved that that mark. So we'll certainly keep an eye on it. We're potentially close for that for GM, but for Ford, I wouldn't expect that to move the needle this week.
Yeah, so David, so then where does that leave Ford, and what does the company ultimately have to do to remain competitive and even just better compete with the leaders within the space right now?
Well, to me, it's for Ford, the elephant in the room is quality control, right? They have got to get warranty costs and recall costs under control. They recalled the most number of vehicles in 2022. They were almost number one in 2023. They're second so far this year. Last year, Bloomberg estimated that recall costs were $4.8 billion for Ford. That's huge amounts of money. On the warranty side, last quarter, this year, Q2, warranty costs were $2.3 billion for Ford. So these are sort of unforced errors that they've really got to get under control before they can sort of look at anything else.
And David, I guess the question is how to go about doing that, right? And what the realistic timeline looks like for investors. Any insight there just in terms of what those expectations maybe more realistically should look like or could be?
Yeah, I mean, look, I wouldn't want to be Ford's C-suite or Jim Farley. It's a difficult problem. Jim has been the CEO of Ford 4 years now, almost to the month. It was October of 2020. And at the time when he took over, he acknowledged that this was an issue that they needed to address. So he and his team have gone into this eyes open. And look, Jim's a smart guy. He didn't get to be the Ford CEO by accident. They're working very hard on this. But it is something where, the efforts or initiatives you may put into place may take months or years to then sort of materialize, right? We're talking about changing or adapting your manufacturing processes, your quality control. So it could be a while. It's difficult to sort of, from the outside, say that or to make a call in terms of timing. But for as long as they've talked about it, I would imagine we would start seeing results soon. It's just TBD on when that starts affecting their earnings.
So is this maybe it almost just can't get much worse from here sort of investment thesis then for Ford, which is something that's been called out from Barclays?
Yeah, in terms of quality control, yeah, it shouldn't get much worse, right? There are some bright spots for Ford. Their Pro division, their fleet and commercial division does well. Ford Credit has really good profit margins. In terms of the products themselves, there are definitely some highlights. They've got the Ford Ranger is all new. That's sort of an affordable, higher volume. The Ford Explorer has been refreshed. That's going on sale right now. They just introduced the new Ford Expedition that will go on sale. That's a fatter margin on that vehicle, completely been redesigned. So there are bright spots for sure. So it's more of a matter of time.
David, I'm curious that one of the big headlines coming out of Tesla's results last week was maybe more of a definitive timeline for Tesla's cheaper EV models and what exactly that could ultimately look like, although there are some questions about how attainable that is. I'm curious to see impact or implications you see on the broader EV market once we do see that from Tesla.
Yeah, Tesla's funny with this sort of $25,000 vehicle has always been sort of the holy grail for Tesla. They were doing it and then they're not doing it. And now Elon is saying that they're actually not going to do a separate vehicle at the $25,000 mark. What he's saying is they're going to take existing models and have it sort of hit the $30,000 mark more of an affordable version of that, and that's after subsidies. So we'll see. You know, the Model 3 was refreshed for the first time this year. The rest of the lineup's pretty stale. I know, sort of excluding the Cybertruck, obviously. 2025 should see a refresh of the Model Y, and that's a higher volume. That sort of has the greatest potential for growth for Tesla. So I think we'll certainly be watching that. But yeah, a lot of other automakers are coming in at the sub $30,000 mark. Going back to GM, they're going to have a couple different models below $30,000, fully electric, next year. So that's going to be, you know, that's certainly going to put pressure on Tesla. And this is, you know, every time we at Autolist poll consumers about EVs, they're always talking about either access to charging infrastructure or cost. So anyone who's paying attention to the space is really trying to get below that $30,000 mark. So there's going to be a lot of competition if and when Tesla gets there themselves.
All right, David Underkoffler, thanks so much for taking the time to join us, Autolist Editor-in-Chief. The crisis at Volkswagen is deepening following weeks of tensions after the company canceled a job guarantee agreement this summer. Workers across Germany paused production to rally outside Volkswagen headquarters. This comes as the automaker plans to close at least 3 factories, eliminate thousands of jobs, and slash wages for tens of thousands of German workers. The company has never closed a factory in their home country, and a plan to reduce salaries by 10% could affect some 140,000 workers there. All this coming before its third quarter earnings on Wednesday, which are expected to show declining sales and profits. Their CEO, Oliver Bloom, has pointed to high costs at the VW brands for the cutbacks, but employee representatives counter that workers are being made to pay for boardroom mistakes. Employees are also worried that the cuts are just the beginning of plans to downsize the carmaker's operations in Germany. Coming up, we will take a look at some of today's biggest stock movers. That's coming up on the other side. Don't go anywhere. You're watching Catalyst. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's what Yahoo Finance's trending tickers page. Today, we have our very own Josh Schaefer joining us here to break down some of the biggest stock moves that we're seeing. Let's kick it all off with Delta. Delta Airlines suing a cybersecurity company, CrowdStrike. This coming after an IT outage in July forced thousands of flight cancellations. The lawsuit accusing CrowdStrike of gross negligence. Delta is saying that the outage reduced revenue by $380 million, brought $178 million in costs. The airline is seeking damages to cover its losses, along with litigation costs and punitive damages. CrowdStrike, of course, fighting back here. It's a he said, she said sort of situation. CrowdStrike is in part blaming Delta's technology right now, saying that they should have been able to scale back their operations in a more timely manner. We will see how this all plays out.
The early market read seems to be Delta investors happy that Delta is trying to go back and get a little bit more of this money, right? You said a reduced revenue hit of $380 million. They had significant amount of their earnings per share dragged on by this, right? They highlighted that. CEO Ed Bastian had told Yahoo Finance, he said, quote, "We had 86 great days in the recent quarter, but we had 5 days that were impacted, caused by CrowdStrike." So that was a big story out of Delta's earnings, right? What's interesting to me, Shauna, CrowdStrike shares not really down today, right? Yeah. It seems like the impact of the outage has been priced into CrowdStrike stock over the last year. You can see it there in the year-to-date stock, the light blue, almost back to where it was before it fell. It started to climb back up to where it was in that mid-July point. And that's been an interesting takeaway for me is if I'm an investor in the cybersecurity space, how exposed am I still to the fallout of what happened? And it seems like for now, the market's vote is, let's let this play out and see what CrowdStrike actually needs to pay before I get too worried about it.
Yeah, and it's gonna be interesting to see exactly where this ruling comes down and what is taken into account, because of course CrowdStrike is saying that they did all they can in order to help Delta. Delta is saying that CrowdStrike should have been able to do more. CrowdStrike is bringing up some of the examples from other companies who have been affected, who have been able to get back their services online at a much faster rate. Of course, when we talked about the outage at CrowdStrike going back to when this did happen, Delta very much front and center just in terms of how big of an impact it did have on their business. So no surprise, and this is almost more of a continuation of what Bastian said on our end, what he's been very public about ever since that this happened, just really trying to place 100% of the blame on CrowdStrike rather than any fault of Delta for their own.
Yeah, to give another quote from Ed Bastian, he told CNBC that, in my opinion, Delta should be, quote, fully compensated for what happened, right? He's been pretty on this already, so I don't think this is necessarily a surprise to anyone. The question is, what do they actually get back? And also, what changes moving forward, right? Delta, an Atlanta-based company, that was part of what weighed on them here, sort of their exposure in that area and their exposure to CrowdStrike. What are the changes moving forward so one outage at one company can't ground over 7,000 flights, right? That's, I think, the key question actually moving forward is, do they diversify exposure in that way where you feel a little bit more comfortable?
Yeah, what some of those stop checks are. All right, let's take a look at Boeing. Boeing is exploring the sale of its space business. That's according to a report from the Wall Street Journal. Yahoo Finance's Akiko Fujita joining us now with more on the company's strategy. Hey, Akiko.
Hey, Shauna. Yeah, there's been some mixed reports coming through the last few days. As you mentioned, the Wall Street Journal reporting that Boeing is exploring the sale of its space business, including its NASA business, while Bloomberg is reporting that Boeing is simply looking to offload its troubled Starliner program. The company spokesperson telling me this morning Boeing does not comment on market rumors or speculation, but all of this speaks to a newer, leaner Boeing the company is seeking under new CEO Kelly Ortberg. You heard him say last week, we are better off doing less and doing it better than doing more and not doing it well. And that statement, you could argue, could be applied to the Starliner spacecraft. It has struggled to compete with rival SpaceX for crewed missions since winning a $4.2 billion fixed price contract from NASA a decade ago. The vehicle was intended to shuttle astronauts to and from the International Space Station, but the project has been riddled with problems around its propulsion system. The spacecraft launched its first crewed mission this summer, but NASA opted to return those astronauts on board a SpaceX vehicle, Crew Dragon, after the Starliner experienced additional mechanical issues on its inaugural trip. Now, all combined, Boeing has reported a loss of more than $1.8 billion directly tied to the Starliner program. SpaceX's Crew Dragon capsule, in the meantime, has completed more than 40 visits to the ISS, with 15 of them crewed missions. Now, beyond the Starliner program, there are now questions about what happens to Boeing's other space assets. There is the Space Launch System, which is a heavy lift rocket at the center of NASA's Artemis program and its ambitions to return astronauts to the moon. That program has also been plagued by delays and quality control issues. The rocket completed its first flight for NASA 2 years ago, but the first moon landing with astronauts on board has now been pushed back 1 year to September of 2026. And then you have the United Launch Alliance, or ULA, Boeing's joint venture with Lockheed Martin. It has been a major provider of launch services to the U.S. government. The company's been in talks to sell its joint venture with Lockheed Martin. Any deal to sell the company would be valued at $2 to $3 billion, according to Reuters. And guys, the most recent reports around that suggest Sierra Space has been in talks with Boeing. Still a big question mark. It really points to, though, not just the challenges within Boeing, but Boeing's challenge or struggles in trying to keep up in this new space economy where it is about moving quicker and scaling bigger. Boeing simply hasn't been able to keep up on that front.
All right, Akiko, thanks so much for breaking that down for us there. Let's also turn to Robinhood and now allowing retail traders, this is an interesting one, to bet on election outcomes. Kamala Harris and Donald Trump contracts will begin rolling out to a limited number of customers today. Of course, this comes on the heels of a recent federal court ruling here effectively legalizing election betting in the U.S. This is the launch of Robinhood now into this space. And this could really, or not could, this does. I guess the question is what the interest is going to look like. But this does potentially open up this types of betting, this type of access to a much wider audience.
The markets have been available, right? Kalshi comes to mind. Interactive Brokers has gotten in this space. Robinhood, perhaps the most consumer-facing name, though. I would probably argue the most name brand recognition here with a lot of people that probably watch our program that might already have money in a Robinhood account, right? And what's interesting to me here, Shauna, is two things. One, if you've been betting on something like DJT or all of these Trump trade aspects to perhaps bet on who's going to win, well, here's your shot to make a real bet. This is just straight up betting, right? You can just bet that Trump is going to win or Harris is going to win, and you can actually make that play rather than DJT stock popping 13% today off a rally. You can actually make a straight bet, right? And so that's interesting to me. Also, interesting to see Robinhood getting into this business. This reminds me a little bit more of a sportsbook casino kind of business, right? Because what happens here is you set the odds, and then next Tuesday there is a definitive outcome, and you owe people money for that. That is not how operating a stock exchange works. There's not a certain day, unless you're trading options, where everyone is going to be owed money. So it's an exposure to a little bit of a different financial model. At least in my opinion, it's the high-level read here. So it'll be interesting to see if they get further into that.
It is, and then exactly, when you talk about further into that, just what exactly maybe this could ultimately look like as we talk about various events down the line.
What else are we going to bet on other than the election?
I don't
right?
know. That's what I was trying to figure out. You actually brought up a good idea during the break. I don't know if you
What, the Oscars?
The Oscars, something like that.
Some of that is only legal in certain states, though, too.
Yes,
So
that's
betting
an
on
issue.
events because people have impact on events, right? That's easier for us to control. That's not legal in as many states as, say, sports gambling is. Right. So it would take further legalization for more events to be able to come. So it'll be interesting to see how that all develops. But for now, we have a week to bet on the election if you want to on Robinhood.
People's Choice Awards was one of the suggestions from the control room, too.
Yeah.
I mean, the options
there's
are really
plenty
endless,
of things. It's just will people actually bet on?
Exactly, and what exactly the interest is going to look like. Again, these contracts are going to begin rolling out today. It's to a limited number of customers, like we said, who what Robin describes as apply and meet certain criteria. So we will see what exactly that entails. All right, Josh, great stuff. Thanks so much. Coming up, the presidential election just days away. We're taking a look at Trump's track record on trade and the implications if he is elected once again. That's coming up next on Catalyst. 8 days from Election Day, and candidates are in the home stretch of their campaigns, making promises to win the votes of the American people. So we're taking a look back at some of the promises that Donald Trump made in 2016 and what he delivered while in office. For that, we want to bring in Yahoo Finance's Ben Workshall to give us a closer look at this. And Ben, what are we looking at?
Yeah, Shauna, I'm a real glutton for punishment. So I decided, in addition to the 5 speeches we get every day, here now to go back to 2016. And so what I looked at was Donald Trump's speeches in October of 2016, so 8 years ago this month, specifically on trade and tariffs, because that's a big issue this time around. And what was notable is, to me, is how many of Trump's promises he was making then he kept. I isolated 5 different kind of concrete promises, and he kept 3.5 of them, which is way higher than his batting average on other topics. He promised to do tariffs on companies that cheat. That's obviously the biggest one. He, as we all remember, that was a big part of his term in office. He promised to renegotiate NAFTA, get out of the TPP. He did both of those things. He also promised, the one he didn't deliver on too much was threats against specific companies, which is interesting because he's kind of making similar threats this time. But the overall picture you get from watching those speeches is that when, on trade at least, Trump kind of means what he says. He really kind of follows through on what he says. And when he talks about tariffs, he talks about tariffs because he wants to do tariffs. And what he's promising this time around is a much bigger new slate of items. He's promising, and one expert estimates it's 10 times what he actually implemented in office. He wants 60% tariffs on China. He wants 10% across the board tariffs on the rest of the world. So when you look back at his previous record, the kind of contention that this is a negotiating tactic, this is bluster, kind of rings a little less true because his record is that he kind of delivers on what he says on trade.
So Ben, real quick, then what are the implications of that just in terms of corporate America for Americans out there? Lots of talk about tariffs and ultimately what that could mean for maybe reigniting some of those inflationary pressures.
Yeah, that's one of the things that economists say a lot, is that this could reignite inflation. What's expected to happen, and the big question, according to experts I talked to, is basically Trump's going to try it if he wins. He'll sort of aim for this. The question is whether the courts intervene to block it or water it down. Congress has ceded most of their authority on this, so the president can act pretty unilaterally. The question is whether it kind of gets caught up in the courts in a way that makes the tariffs less intense than what Trump wants. But the overall picture, I think, for corporate America is that Trump, if he wins, is going to try it. The question is kind of how much Washington lets him do.
All right, Ben, always great to get your insight. Thanks so much for hopping on with us here.
Sure thing.
Let's stick with the election and Trump media stock. It's soaring once again today as the election day gets closer, hitting its highest level that we've seen since July. You're looking at a jump of just about 15%. Now, the move higher coming after Trump held a rally at Madison Square Garden in New York City last night. Joining me now, we want to bring in Matthew Tuttle. He's Tuttle Capital Management's CEO. Matthew, it's great to have you here. So I know you've been a buyer or better here on DJT in the past. How are you playing DJT right now?
So right now, I mean, it's a binary bet on the election. If he wins, maybe it does something. But I think it's a buy the rumor, sell the fact. So I would imagine that the day after him winning, you'd see this come down. If he loses, I think it goes to zero. So, I used to kind of trade in it on the long side. Now I usually will buy puts if I think it gets way too extended. So, we own some puts on it right now, for example.
Matthew, I'm curious, what have you made just around the, I don't know if you want to call it excitement or just concentration or focus surrounding DJT in relation to the election? Is this anything like you would have expected, and maybe what that signals about meme stock trading or retail investor involvement then going forward?
Yeah, I mean, it's exactly as I would have expected in this environment. Look at some of the other stocks, around some of these names like a Michael Saylor and MicroStrategy, Elon Musk and Tesla. Trump's name on this thing totally changes the game. And, anyone trying to, put like a normal kind of PE ratio or something on something with Trump's name on it, I mean, you're going to drive yourself crazy doing that.
Matthew, I'm curious, just your approach with DJT. Are you involved with other meme stocks and maybe how the trading patterns are similar or different than some of that other activity that we've seen play out on the street?
Well, yeah. So we just actually launched an ETF 2x long MicroStrategy, MSTU, and just watching that trade, I mean, it's almost at 900 million assets, and we launched it a couple of weeks ago. The MicroStrategy guys are just rabid. We have 2x long Tesla, not as crazy as MicroStrategy, but certainly another name, and NVIDIA to a lesser extent. So we do love kind of the trading action around a lot of these names with very, very well-known and out there founders.
Matthew, if Trump does win next week, what do you think the upside looks like for DJT?
So again, I think it's going to be a buy the rumor, sell the fact. This company still has a lot that it's got to do, because of the core business. You got to wonder, why do you need a Truth Social platform? Back when this came out, before Elon took over X, yeah, but now Trump's back on X. All the conservative voices who were kicked off are back. There's no censorship. What do you need Truth Social for? So they're still going to have to execute. I would not be buying this, the day after Trump wins. Things have got to settle out. Can they do it? They could, but it's going to be difficult.
Matthew, do you have another, or not another, do you have a top play then heading into the election, maybe a bet that you are making that you think very much hinges on who wins the White House?
Yeah, my favorite Trump stock is Geosystems. It's a prison operator. At the height, back in Trump's first term, it was about 10 points higher. And that's a real company and with some real kind of thematics behind it if Trump wins. Tesla is another one, and that's almost a binary bet, because if Trump loses, I think Elon Musk becomes public enemy number one, and that's not great for Tesla. If he wins, Elon Musk is very, very, very influential in the government, which is obviously a good thing for Tesla.
Yeah, lots of questions about how that is all going to shake out too. Matthew Tuttle, great to have you. Thanks so much for joining us.
Thanks.
Coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Riley Smith is back, and he's got you for the next hour. Stay tuned. I'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, today is the start of a busy week. We have earnings from most of the Magnificent Seven companies, inflation data, and several reads on the labor market. Plus, we're just over a week away from the 2024 election day. On today's show, we've got a lot. Apple Intelligence finally coming to your devices. Yahoo Finance's tech editor Dan Howley will lay out everything you need to know about the new features. And President Biden is proposing a plan that could deliver student debt forgiveness for up to 8 million borrowers across the U.S. We'll find out who could be eligible and how likely this plan is to stick. Plus, a new tax year will bring new tax brackets for many. An expert will explain what the new brackets could mean for your tax bill. All that and much more during today's show. But first, let's take a look at some of the market action here. We are 90 minutes into the start of today's trading activity. The Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite holding on to gains here. Fractional as they may be, we're higher across the board. You've got everything this week. You got earnings, economic data, and an election. Investors, they've got a busy week ahead. And to discuss the best plays for your portfolio, we're joined by Liz Miller, who is the Summit Place Financial Advisors founder and president. It's great to have you here with us. So first and foremost, I mean, we're here in the midst of earnings season, but we're also going to get a slew of economic data this week. Which and how do you think investors should be prioritizing what's going to be released over the course of the next few trading sessions?
So I think the economic data is the focus. You know, we're all living at a very precarious time going into this election. So of course that seems to dominate our thinking. But when we're talking about investors' choices, we say we're kind of at the end of this earnings season, which has looked fine. We're seeing that companies did okay over the summer, and they're giving us some outlooks into the new year. It's all going to be about the economics, because what we really want to know is, will the Fed be continuing to lower rates into the end of the year? And what does that pace look like? That is so going to define our economic future.
Yeah, it's so interesting, especially thinking about this economic data and balancing that with the earnings season, as you were just so aptly doing here. And I'm taking a look at a note that hit my inbox from UBS, looking at the outlook for profit growth and saying that it really remains healthy, driven by resilient economic growth, a boost from further Fed rate cuts, and continued growth in AI spending. But I want to zero in on that boost from further Fed rate cuts. What is your anticipation as to how that will kind of permeate throughout the market as well?
Well, what's funny is on the way up, it certainly didn't strangle activity the way everyone feared. You know, the markets really reacted that 5% interest rates were going to just strangle consumer activity, and that didn't happen. But we did see struggles in some big areas. We certainly have seen housing struggle. And as rates come down, construction and housing spending are such a huge driver in our economy. If you think about it, from the daily construction worker to the washing machine you buy to the new roof that goes on, when construction and home sales pick up, it permeates every part of our economy, and it trickles down to consumer spending too. So it's a huge driver, and we need those declining rates to get that moving again.
With that in mind, what are some of your top plays right now that you're putting into action as we're here in the fourth quarter of 2024, and then investors perhaps sharpening their pencils, or at least inking their pens, feather pens as they may be, for 2025?
Right. Well, I think one of the easy buys right now is equity residential, ticker EQR. It's the largest REIT in our market. It is in the S&P 500, and it's the largest residential REIT. It has a really nice yield right now, over 3.5% at a time when rates may be coming down. And as home sales, home activity picks up, this is going to be a continued beneficiary of that. So I think this is an easy buy for a 2 to 3 year hold right now.
With that in mind, I mean, for investors that are trying to figure out their portfolio positioning, what are some of those top themes, even outside of residential and the housing market, that you see really transpiring over the next 3 years if an investor is looking at that time horizon specifically, as you were mentioning a moment ago?
Well, I think, you know, we're all talking about big tech, and so I'm not going to talk big tech, but it is core. You know, we used to think technology was not a stable investment. It was not the investment when economic cycles were moving around. But we have found that technology, particularly large technology, is a very stable holding. So we do hold those big names, and we encourage everyone who has them to keep them. But one of the things we're turning to that's been sort of on the outs is healthcare. We think that you will see, as this economy kind of hits its slow growth stage, that investors will be rewarded to be exposing themselves more to the healthcare sector than they did in the past.
Yeah, really interesting. We actually had the Philips CEO on during Morning Brief here today on Yahoo Finance. Liz, thanks so much for taking the time here with us. Liz Miller, who is the Summit Place Financial Advisors founder and president. Appreciate it.
Thanks.
Well, Apple's AI features called Apple Intelligence. They're expected to come to a device near you this week. Here with more on what's to come, we've got Yahoo Finance's tech editor, Dan Halley. Hey, Dan. So what is a brewing over at Apple right now?
Yeah, Brad, this is going to be an update that users will get sometime this week. Apple hasn't said exactly, but it's part of iOS 18.1, iPadOS 18.1, and macOS 15.1 Sequoia. And essentially, the big takeaway from this is it's a start for Apple. This isn't going to be the thing that gets people rushing out the door to buy iPhones right away, but it does start to lay the groundwork for what we will see that could get people more interested in re-upping their phones when it comes to the next iteration of Apple Intelligence, and that's currently in beta. That includes things like ChatGPT integration with Siri and Apple's visual intelligence lookup. But let's go over what's included in this update itself. There's notification summaries. That's essentially going to cut down on the number of notifications that you get throughout the day just by literally summarizing everything that comes in. For instance, yesterday I was getting my fantasy football updates summarized, text messages summarized, news reports summarized. This morning I got my dose of Yahoo Finance news summarized as well. It shows up on your home screen on your iPhone, the notification center if you want to pull that up as well. And it's easy to use this to kind of triage your notifications and know, okay, I can skip this or I don't have to skip this, and I need to get to it right away. One of the other things that they announced is writing tools. This is something that we've seen from other companies as well, where essentially you'll be able to summarize, proofread, change the style of tone for some of the things that you write and get some ideas for writing as well. And so that's going to be available across the entire operating system, whether that's iOS, iPadOS, or macOS. So you'll be able to do that in text messages, you'll be able to do that in emails, third-party apps. It's just going to be all over the place. And it can be a helpful tool, especially if you don't feel like reading through a whole long email and you want to summarize it. Speaking of emails, they also have priority inbox. So that's something where you're going to get notifications for what Apple Intelligence believes are priority emails, things that are based on time, timeliness, things along those lines. I've been getting it for our kind of Yahoo Finance video team notifications. I'll get that in my priority inbox for the next morning. And you can also get email summaries in the email app. So that's something that's also very helpful. On the fun side of things, there's some photo changes as well. There's something called photo cleanup. Basically, it'll let you take small objects out of your shots or people in the background. This isn't something where you can say, take a picture and remove your X from it. It can't take out huge chunks. It's going to look awkward, but you can take out small things. So if there's trash in the background or something, you can get rid of that, and no, your X wouldn't count as trash either. And then there's also natural language search. It's something where you're able to say, okay, if I want to look up photos of my wife from when we were in Paris, I could say look up pictures of Lisa in Paris, or look up pictures of Lisa in a red dress in Paris. You can get that specific. And so it's able to do that. It can be a little hit or miss sometimes, though. It won't show you all of your photos either, so you may still have to do some scrolling. And then there's some Siri updates as well. Basically, Siri's getting a facelift with when you press the side button or say, hey, Siri, it'll show kind of a glowing rectangle around your device. You'll also be able to type to Siri now, which is very helpful. Sometimes you just don't want to talk out loud and ask Siri a question. It's going to get a lot smarter with ChatGPT. Hopefully, we'll see when that's available. It's currently in a beta for developers. And those are really the biggest things I think that you're going to get to play around with when this finally drops.
Yeah.
As I said, I don't think it's going to be a big sales driver for the iPhone, but that may happen with the next round of updates.
That is so interesting, Dan, because I mean, I'm taking a look at some of the IDC data. I think it dropped last week. You may have seen it as well, talking about Apple re-entering into the top 5 in terms of the smartphone companies out there. And really what they had focused in on was, despite the ongoing economic challenges, consumers highly motivated to purchase new smartphones after 3 years of pent-up demand. And it was driven by some of these features that you're talking about. Net, were you impressed, and do you expect consumers to be impressed once they get it within their fingers and within their hands?
I think that when it comes to being impressed, I think the notification summaries is really going to be what people notice and use the most. Writing tools, I think that it's something that, most people probably won't dive into it very often, but when they need it, it's there. I think the photo cleanup is going to be something that people like to use when you want to post on Instagram or something like that, and you want, the perfect shot. That's something that I could see people using. The natural language search in photos, incredibly helpful, because we've all been at a party, you're talking to someone and like, oh, let me show you a photo, and then you end up scrolling forever. That's hopefully going to eliminate situations like that. But I don't necessarily know if this is really going to have people super jazzed. They may think, well, that's it, because the ads that they're running kind of make you think that this is the whole kit and caboodle when they start to launch Apple Intelligence, and they kind of are probably overselling a bit versus what's available or going to be available. I think the next kind of set of features, that 18.2 for iOS and iPadOS and 15.2 for macOS, I think that's where people might start to get really excited.
Embellishment and marketing. Say it ain't so, Dan. Come on now. Dan, thanks so much. Appreciate it. Coming up, everyone, we're discussing Biden's latest student loan cancellation proposal. That's right after the break. Stick with us. The Biden administration takes another shot at student loan forgiveness, this time for Americans who have financial hardship that prevents them from repaying their loans. To discuss what this might mean for you and your student debt, we have Amanda Haenel, who is the Fidelity Investments VP of Emerging Products and Student Debt. Thank you so much for taking the time here with us today. First, as you think about this effort, how does this differ from efforts past and the type of impact that is anticipated?
It's a great question. I think when you look at a lot of the efforts that the Biden administration has made towards student loan forgiveness, what's clear is that there's a lot of attempt to help those with financial burdens. There's also a lot of tug of war in DC around how these will be actually pulled into action by people. And so when you're looking at the overarching result for those with student debt, what we recommend is really making sure that you are keeping up with an action plan as we wait and see how this works through DC.
And so how many are anticipated to be able to take advantage of this forgiveness here? And really, it kind of is more telling about the financial hardship that many who are trying to repay student loans but cannot because of that hardship are actually facing right now.
That's right. So this is a more targeted forgiveness. It has about 8 million people who are anticipated to receive some kind of forgiveness if it were to continue through to action, comparatively to about 40 million who would not qualify for it. There's lots of different ways that this administration has started to look and say, how can we actually provide additional help for those who have hardships with student loans, whether it's deferment of payments or different types of loan repayment options, all of which are worth knowing if you are a student loan borrower who is really struggling to make those monthly student loan payments.
You know, for those who may not fall under this particular forgiveness or larger plan, what are the steps, the top tips that you were telling repayers of these loans who are trying to make sure that they can either get back in good standing or just get on good footing with regular payments?
Yeah, absolutely. We recommend a couple of things. The first one is to have a plan. So you need to really make sure that you can get organized, get informed, know who your loan servicer is, and then look about how that actually fits into your financial profile. How much can you afford to pay? Can you start putting money aside and paying some of that? And then if there are options that don't work for you, talk to your loan servicer, see if there's different types of repayment plans within there that might be better suited to your needs. And the final one is to actually talk to employers. They're really starting to lean in and offer additional options to help you with that student loan payment.
And with this all in mind, I mean, thinking back to where those loans originate, it's typically at the beginning of that college exploration and higher education type of exploration decision making that individuals and their families are making as well. For those who are just trying to figure out, okay, how do I make sure that if I need to take on a loan, it's one that I can certainly pay down over time and ultimately start a better pathway towards savings and not just paying down debt? How can they identify where a loan is worth it and where it's not?
Yeah, so it's going to be super personal in what you actually think is worth it with your projected career choices, but thinking about where you have the ability to pay down that debt that you're taking on for the kind of education that you're receiving is always helpful, and making it real in terms of the monthly payment that you're projected to have after college. So what can you be expected to pay? How does that fit into starting salaries? And what does that look like for you? The same kind of planning that people with student loans can do in terms of making those kinds of adjustments are what you can do before you actually take out the loans for college.
Are loans or just the cost of college dramatically changing the type of degrees, programs you see people who you might even be advising that they opt into, and how do you see that kind of calculus being run at the family level as well?
Yeah, so we see a lot of, especially high schoolers, those who are starting to go to college, really starting to think about the cost of college and thinking about what kind of degrees they might want in order to be able to go there. So certainly, I think the cost of college has become a real consideration and factor in what type of degrees people are coming into and what the conversations at home are between parents and children as they're starting to go out, making sure that they all feel comfortable with that financial burden that is going to be taken on in order to reach higher education.
Amanda Hanel, who is the Fidelity Investments VP of Emerging Products Student Debt. Thanks so much for taking the time.
Thank you.
Coming up, everyone, the IRS announced new tax brackets. We'll break down what it means for your tax bill next on Wealth. The IRS announcing new federal income tax brackets for 2025 to adjust for inflation. Now, the brackets help determine how much of your taxable income you owe the government. Joining me now to break down what you need to know, we've got Mark Stieber, who is the Jackson Hewitt Chief Tax Information Officer. All right, so what are the biggest changes for filers?
Well, there's a whole host of changes that happen each and every year. Part of what we're talking about are the inflationary adjustments, but those, to be clear, are for next tax year, not this year when you do your taxes in 2025. So the rate brackets, the standard deduction increase, the earned income increase, and a dozen others, those are adjusted each and every year by the IRS in order to prevent bracket creep. And what is bracket creep? Well, if you got a 5% raise, for example, and they didn't do this, you would move into a higher tax bracket just because your income went up to adjust for inflation. You'd pay more taxes and you'd be economically worse off. So the IRS adjusts a host of things to reflect inflation to keep everything status quo. Now, to your question, nothing's ever status quo between life changes, tax law changes otherwise, and everything else that goes on. Likely your taxes are different each and every year. And so it's important that you pay attention to your largest single financial transaction, namely your taxes, and not just the inflationary adjustments.
Okay, and so we're looking at some of these bracket adjustments and the new levels here. What are some of the big items that have changed as well within these new tax brackets?
Well, I'll start off by saying the standard deduction went up handsomely to also give people a bigger tax break if you don't itemize. Earned income tax credit went up, child tax credit, and those are just the ones that are being adjusted for statutory inflationary adjustments. As we know, we're right in the midst of a presidential election, but who knows what 2025 will look at. And we have enough for 2024 right now, which starts in about 67 days. So there's a lot to watch and a lot to watch out for. 2024 was 67 more days in it, and then 2025, of which you're talking about, already has changes on the books from these rate adjustments to bracket adjustments, standard deduction adjustments, and a whole lot more.
My goodness, my heart almost jumped out my chest when you said 67 more days in 2024. My goodness, thanks for putting that in perspective here. Mark, as we're thinking about what people can start doing now to prepare themselves for the next tax filing season, how can you kind of get your affairs in order well in advance here?
Well in advance would have been last summer, but with 67 days, I have a couple of 3 tips for your viewers. The one thing you should do if you've not done, and I recommend this to all of my clients and our clients at Jackson Hewitt, you need to do a year-end tax projection. Right now, with October wrapping up, you have about 4 more payrolls or 2 more months. Take your October 31st information, your pay stub, your earnings statement, estimate 2 more months worth of income, do the same for your withholding, do a rudimentary tax calculation in the margin of last year's tax return, adjust for some of your passive income, dividends, and interest. You should have those statements and kind of see where you are with a big high-level projection. If you get an answer that's shocking, whether you owe a balance due or a big refund, you might get some help and take a little bit more action. But other things you can still do with 4 weeks or 8 weeks left to go, you can maximize those retirement accounts. If you've not, you've got a couple more payroll cycles. Look at those cafeteria plans or those health insurance plans. Make sure you're spending that correctly, because that has a cap and a lock on it. Health savings accounts, if you're going to set one of those up for next year, you have to do those. And then those Roth conversions are also very hot. The one thing I would tell your viewing audience, though, that's my number one easy pick, go look at those loss losers in your portfolio. Get rid of those. They're not going to come back. You know it. Accelerate those losses into this year. You can take an offset against your other gains, or you can take up to $3,000 just offset against ordinary income. So look at that portfolio, do a little bit of house cleaning while you have a few weeks left, and get those lost dogs out of your portfolio.
Mark, I'm going to go rogue here, but it's because I trust that you have a great answer on this one too. A lot of people are going to be doing some smart spending over the course of this holiday season as well. How can they make sure that their smart spending also perhaps gives them a tax advantage when they do file next year?
Well, there's a couple of buckets of people that's particularly important for. If you itemize, and we'll talk about those second. The more important people are your self-employed people that have that home-based business, and there's like 40 million of them. Those people have a great deal more control over their tax outcome than you might think. They can certainly put off billing and defer some income, but more importantly, and this is a time-tested strategy, you can accelerate some deductions. You can make some of those purchases before year end. You can watch out for those gifts that you give to your clients, because some of that might be deductible up to a cap. But keep track of your self-employment activity, and in particular, if you're in an income position, Consider moving some losses or some deductions into the current year by some purchases of equipment, expenses prepaid, or even buying some gifts from those valuable clients and putting that on your tax return as a tax deductible item. So if you have control over that, that's great. Now, if you're an itemizer, as I mentioned, you do get the standard deduction, all Americans do. But if you're an itemizer, that is to say your mortgage interest, property taxes, state income taxes, medical expenses, and charitable deductions, those can go into this year, but they have to be spent before December 31st. So if you're an itemizer, consider some of those year-end charitable donations and keep good records. Also, consider making perhaps an accelerated home mortgage payment, property tax payments, or some of those other items that can go onto your tax return. I'll simply say this, before you go down this road though, get some guidance from a trusted tax pro. Ignore all that TikTok fodder. It's usually more dangerous than true.
Mark, I knew you'd have a good answer. Thanks so much. Mark Stieber, who is the Jackson Hewitt Chief Tax Information Officer. Appreciate the time, Mark.
67 days.
There you go. Everyone, we've got much more on wealth after the break. Stick around. You're watching Yahoo Finance.
Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This indeed is the podcast that will help you learn a lot about investing in the hopes of making you smarter and in the hopes of helping you make a lot more money, which of course is a good thing. Before I get into our interview of the day, I have to start with our stock of the day. My stock of the day, surprise, surprise, is NVIDIA. I mean, this is the most popular stock on Yahoo Finance, and I'm bringing it to light here today because it is shares of NVIDIA down 5% from the record high that the stock hit earlier in the week. And that is in large part to a surprise warning from chipmaker or chip play ASML. Really shocked the market, shocked all the investors in AI stocks with a warning on their forward outlook saying weakening demand in non-AI applications and also calling for a gradual recovery in demand. NVIDIA didn't like that. NVIDIA investors didn't like to hear that. AMD investors didn't like to hear that. But I want to point to this, guys, before I get to our interview subject of the day. You know, a recent note out of JP Morgan saying they met with the management team in NVIDIA, and they're saying that the next generation Blackwell chip is ready to go into high volume production in the fourth quarter. That's the quarter we're in now, folks. And demand and yields look to be improving. And any production problems that NVIDIA had a couple months ago with this Blackwell chip are done and dusted. So you have to start thinking about, is this NVIDIA sell-off overdone? I'm not going to tell you yes or no. I do not pick stocks anymore. I just want to leave you thinking there remains a lot of fundamental positives to the NVIDIA story. All right, enough NVIDIA for the day. I could talk about that all day, but I want to talk about some monetary policy, some gold, Fed outlook, lots of things. And I will set this up as this. You know, we have not had one repeat guest on opening bid, but our next guest I felt was very important to bring back and continue the discussion we had a couple months ago. That is Judy Shelton, Senior Fellow at the Independent Institute. Judy, good to see you again. You know, since we last saw you in our studio, we're now on the NASDAQ. The NASDAQ team lets us come down here and do these amazing podcasts. Gold prices have gone through the roof. I mean, I guess it's a Judy Shelton rally, right?
I think it's a rally, but it may have more to do with Costco stocking gold. It's a very trustworthy company. And I think it might reflect a collective yearning among consumers for real money. But it is a phenomenon. I think in the last year, it's probably up over 40%.
So we've talked in the past that, and you're a gold expert, you've spent a lot of your career studying gold, what drives it, what doesn't drive it. What does it say that that Costco, a retailer known for selling meat, bulk goods, is essentially selling about $300 million a month in physical gold bars? I mean, what is the economic read-through to someone that has studied gold for many years?
Well, when I've studied gold, it's been in the context of historical monetary systems and how economic performance is affected by the underlying monetary foundation. So I don't look at it as an investment, but as more a reflection. And I think that people have had a bit of a shock in the last 2 or 3 years, seeing real inflation getting up as high as 9%. But say since January of 2021, they've seen the dollar lose 20% of its purchasing power. And I think for some investors who buy at Costco, maybe they're just being savvy. I mean, they are making a profit. Other people might be very prudent. They're diversifying their portfolio. But I think it also is reflecting this yearning for real money. Gold is kind of a surrogate for the real economy. And it represents commodities, but also that traditional role of money you can trust. It's a meaningful unit of account. It works across borders. It has universal value, and it's highly recognized. It's a store of value. It doesn't mean gold is going to increase in its dollar value, but it probably does. And I think that it reminds people at one time, our own system was based on a specific weight of gold. So to say that today the dollar should be as good as gold is to say, let's learn from historic systems, because they did deliver some real benefits to people, including the right to convert at a pre-specified price your paper currency. That's what we're missing, is that accountability for our central bank, the Federal Reserve.
My view on gold is probably a lot simpler than yours. I was trained to view gold as one buys gold because they expect unrest at some future period of time. So I have that gold bar and I may need to use it to buy a loaf of bread. I mean, from an economic standpoint, do you see trouble ahead in the economy that would warrant going out and buying gold?
Well, I think the same people who are concerned about a sudden breakdown in civil obedience, kind of an apocalyptic scenario, do know that gold is seen as a medium of exchange automatically. It has that traditional role. I would say in a less hysterical way. I mean, I'm not saying these things won't happen, but let's say if we have a basic positive outlook for the geopolitical situation, we might nevertheless see gold as that safe haven that I think you're referring to, because hopefully we don't have to buy a loaf of bread with it, but it is a mainstay. In that sense, it's an alternative currency, a real currency that fulfills those functions of of a medium of exchange. You could use it for transactions as basic as buying bread, but it also is a store of wealth, and it provides a unit of account if everyone is also using precious metals.
I really hope we don't have to use gold to buy loaves of bread, because if we do, I mean, there's something that has gone really, really wrong. So let's switch a little bit to, and I should say this too, to Yahoo Finance community watching this on YouTube, watching on Yahoo Finance, please drop us a comment. If you're out there buying gold bars at Costco, love to know what you were thinking, putting your hard-earned money to go out there to a Costco or other places to buy gold, physical gold, gold stocks. Very curious. Drop us some comments in the section. So Judy, since you also last talked, the Fed has made a big shift on Fed policy, came out, cut rates by 50 basis points. But now there's talk that the Fed may skip a rate cut. Bigger picture thinking, is this a market that is still too dependent on what the Fed does?
Absolutely. Absolutely. I think the obsession with the Federal Reserve is a form of sickness in a way, because it detracts from entrepreneurial decisions. Instead of making investments based on where you see value, where you see a chance to employ your capital productively, it's too tempting to just arbitrage the utterances of Fed officials. I think what we saw when the Fed didn't lower rates in July, and then there were some alarming labor numbers, the Fed kind of panicked, and at the September decision did something very aggressive to go 8 straight Fed meetings at the highest rate in 22 years and leave the interest rates at that high rate, and then suddenly drop 50 basis points, only to have the labor numbers come out a lot more favorably within a few days. And now to see a slight uptick in the consumer price index, I think it made the Fed look slightly silly. And especially, in my opinion, because at the press conference, the chairman of the Fed, Jerome Powell, insisted that they didn't drop because there was anything wrong with the economy. He said labor markets were solid, growth was good. So the Fed, in a way, is disavowing its own framework, the paradigm it has been relying on. I even noticed one Fed governor, Chris Waller, said yesterday, we're going to be more cautious now because the economy isn't slowing as much as we hoped. Now, I think it's an odd outlook for our central bank to be taking. I don't think growth and productive employment is inflationary, but the Fed says nothing about fiscal. And we have a lot of spending, deficit spending going on in this economy that I think is fueling higher prices without increasing supply of products. And what you want to do is increase the supply of consumer goods and services. And that's how you meet demand, not by trying to cut off economic growth, which is the way the Fed approaches it.
So what should the Fed, in your view, be doing next year? Should they stay the course with these rate cuts? Or, I mean, it seems really, it's confusing. I mean, we're looking at this, trying to have this discussion on handicapping what the Fed may or may not do. I don't know how the average investor could survive a moment like this.
I think the Fed does far too much. I think it's the ratcheting up and down that causes the problems. What you really want to do is bring back price signals. You want a free market to work in a way where the demand and the supply of loanable capital is determined organically. It's determined by the people who are actually in the economy, and not by a small committee of 12 FOMC members, the Federal Open Market Committee, which makes the monetary policy, meeting 8 times a year to decide what should be the most important price in an economy devoted to free market entrepreneurial endeavor. I mean, why would you fix the price, like in a central planning way, of that resource, financial capital? And I think we would be much better off if the Fed wasn't ratcheting up and down. Both candidates for president insist there will be inflation under their rival. So now the Fed is embarking on cutting rates. Is that just so it can raise them again?
Judy, before we go to break, I mean, is Chair Powell part of the problem here?
I think I don't want to blame him specifically. I don't want to doubt his motives. But I think having a structure where you imbue the chairman of the Fed with this sense of infallibility or omniscience is unhealthy. No one can know how to calibrate the amount of money and credit for a massive system, not just the United States, but really throughout the world. The only closed economy is the world economy, as my old mentor, Robert Mundell, Nobel Prize winner, always said. And I think to suggest that the members of the Fed have this kind of sacred responsibility where they insist that price stability is the responsibility of the Fed, and then there's no accountability when things go wrong. Nobody gets fired. No one who uses the dollar gets reimbursed for the loss of purchasing power. They're stuck trying to nag their supervisor for a cost of living increase. I think we deserve sound money. I hope there's a revolution in favor of sound money. The book Good as Gold, the subtitle is How to Unleash the Power of Sound Money. And I think we need to relink in some way the dollar to gold to establish a marker to say that we're going to get our fiscal and monetary house in order in the future, and to start to reintroduce that kind of discipline to suggest that a dollar really should be as reliable and dependable as gold has been for so long, including for the United States.
Judy, hang with us. We're going to go off for a quick break. We will continue the discussion on the other side of that break. All right, welcome back to Opening Bid. Having another fascinating conversation with Judy Shelton, Senior Fellow at the Independent Institute. Always enjoy catching up with Judy. So a recent interview by former President Trump, Judy, and the former president, I guess, doubled down on his comments that a president should have some form of say in Fed policy. He didn't come out and say outright he should be controlling Fed policy or whoever the president is, but he should have some comments. Like, what's your view on that?
Well, I think when people ask even prospective members of the Federal Reserve, well, would you listen to President Trump? It's such a loaded question, and it's kind of ridiculous. I mean, Chair Powell meets with Janet Yellen weekly for breakfast, and she's the Treasury Secretary who's working directly for the President of the United States. Should the Fed officials be hermetically sealed? Should they be allowed to meet with members of the administration? Powell also meets with Lael Brainerd. She's the chairman of the National Economic Council. She's the top economic advisor to President Biden. And it's just more than coincidental, I think, that both Janet Yellen and Lael Brainerd were the chair and the vice chair of the Federal Reserve. So until you're prepared to say that that the Fed chair refuses to take a phone call from the president of the country, then I think you're talking about a rogue agency. And these are unelected officials. I did notice when President Trump mentioned that at the Chicago Economic Club most recently, he made a point of saying, I can't order what the interest rate should be, but I think I have a right to express my opinion. And I feel like everyone, I said this at my own hearing, everyone has a right to be critical of Fed decisions. And I hope we're not going to begin to censor people, let alone the president, from expressing their opinion about monetary policy.
An interesting stat that I came across my desk. Let me read this one off for you, Judy. The Committee for a Responsible Budget estimates that policies floated by the former president would widen the federal deficit by $7.5 trillion over the next decade. What do you think about that?
Well, I am increasingly skeptical of expert estimates of such things. I don't think that those same experts saw that by reducing taxes and the regulatory burden that we would get increased revenues, very much in keeping with the theory of Arthur Laffer. I don't think that they anticipate all of the spending that government has been doing. When you look at tariffs, I'm not sure we know how to express how that will impact the economy, because in some ways, the whole idea is if people say now that something being imported is more expensive, they may choose not to buy it. Some of these assessments assume that everyone will just pay that higher price. But I think the idea is to say, unless someone's a monopoly supplier and there are no alternatives of goods comparable being manufactured in our own country, then you have a different sort of a problem, possibly a national security problem. But I can't believe that there wouldn't be potential producers of comparable goods and services within 20% who could then have a chance to establish their own market appeal. And I think people could switch. So I think we have to be careful in assessing the impact. But I do like the idea, frankly, if Elon Musk were to be brought into the government in a way of having more efficiency, possibly cutting down the size of civil service employees. Maybe we have too many people doing things that don't necessarily provide the service that is intended from government. I would like to see more efficiency in government. So I think all of those other factors need to be taken into account. And that's why I'm very distrustful of so-called assessments that I don't think understand in a dynamic way what a supply-side oriented economic agenda would do to increase productive economic growth that could be very, very good for our country in terms of overall performance.
So you think what Elon is floating here is a potential good idea? Look, I'm not a political historian. I mean, has there even ever been a position like the one he has floated? And how fast do you think, let's say former president does get reelected, how fast can Elon Musk move within the tight confines of the U.S. government?
Well, there has been a precedent. We've had commissions before looking to balance the budget, and that included spending initiatives to cut fraud and abuse and all of the words we normally apply to this. But I do think it would be unique. We have someone who has talked about establishing a Department of Government Efficiency, which happens to sound like Doge.
Coincidence? I think not.
Possibly not. He may be ahead of all of us, and he's a good marketing guy. But I do think that what he demonstrated when he bought Twitter and changed it to the X platform and immediately cut a huge number of employees, it's a harsh thing to do. But I also think that if you have layers of government bureaucracy that are impeding growth and making life difficult for entrepreneurs, who to me are the heroes of our economy, I think you could benefit. So I would like to see the size of government cut, but in a thoughtful way. It's not a matter of eliminating all regulations. It's a matter of subjecting them to a cost-benefit analysis. And I think that would be key and possibly very powerful.
Since we last spoke, Judy, we have gotten more details on Vice President Kamala Harris's economic plan. As you have unpacked that or studied it, is there anything in there that you think would benefit the U.S. economy, and to what extent would it benefit?
Well, I noticed that she just copied the idea of no taxes on tips. I guess tips for me do represent the closest link between performance and merit and compensation. And I think it's important to strengthen that link between effort and reward. But her other programs really leave me cold. I think accusing companies of price gouging is just the last refuge of a scoundrel. The inflation is not caused by the business. It's not caused by labor. It's caused by government. And so I think it's a real cop-out to then say these are greedy corporations. I resent even that insinuation. So I'm against that. I'm against handing out money to be a first-time purchaser of a home. I'm very sympathetic, especially to younger people who would like to start acquiring financial assets. But just giving away money or even to businesses. She's announced a program oriented toward Black Americans. I think that's just an anti-American idea to give government rewards based on skin color or gender. I find it very distasteful. So I don't like the giveaway programs. I think she called them loans that could be forgiven. I don't like forgiving student debt. I'm sympathetic to students who have accumulated it, but I think you have to be responsible for your decisions. And there are plenty of people who didn't go to the expensive college or get that student loan who are paying the price, but they're also earning a living, and they shouldn't have to be paying for the decisions of others.
Judy, real quick, lastly, what's your economic outlook for next year? I mean, do you see things steady as she goes?
I have to say, I think it's very dependent on how this election turns out. Mm-hmm. I think that the country could be dynamic, could be successful. I think that we could be a beacon of hope to the world. I just got back the day before yesterday from a trip that took me to India, but also to France. And I talked with people who really want the United States to handle its issues with excessive debt, to handle the problem of high inflation and high interest rates, and having government debt eat up all the capital. And they say we all need economic growth. They're looking to us to kind of reprioritize the private sector and to elevate the individuals who are working in the economy above the government officials who rule over them.
Sure. Fascinating discussion, as always. I should mention, Judy, you were the first one to commit to the big Yahoo Finance Invest Conference coming up on November 12th in New York City. I mean, we have an amazing lineup of guests. Of course, Judy Shelton, Apollo co-founder and CEO Mark Rowan. Of course, Apollo is the parent company of Yahoo Finance, Bank of America CEO Brian Moynihan, Neil Kashkar, Minneapolis Fed President, so lots of just amazing people coming up on stage. Looking forward to seeing you there. Judy, we'll talk to you soon. Judy Shelton, Senior Fellow at the Independent Institute. We'll talk to you soon.
Thanks, Brian. Great to be with you.
All right. Likewise. Thank you for coming on. All right. That's it for the latest episode of Opening Bid. Please like, subscribe, hit us with those 5-star ratings on Spotify. Wherever you find us, just give us some love. We'll talk to you soon. On the hunt for the hottest market commentary? Then join me, Yahoo Finance's executive editor Brian Sozzi, on Opening Bid, a show with unrivaled insights from top money managers and analysts. New episodes of Opening Bid every Monday, Wednesday, and Friday starting at 8 a.m.
All right, with that, we're almost at the midpoint of today, and let's take a look at markets right now. We are taking a look at the Dow, the S&P 500, and the NASDAQ, higher across the board. The Dow up by about 0.6%, S&P 500 0.3% there, NASDAQ Composite 0.4%. Busy week of earnings. We've got economic data as well, but for us, here and now, as Luther Vandross would say, that's it. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern. You don't want to miss it.